about, okay, you can hear me now, right, Prince?
Prince? Yes, sir, I can.
Okay. The audio is good. Okay. So we were talking about three broad areas, right? We were saying return on time invested. We were talking about uh, in terms of longevity of investing yourself, and then also about being active investors, right? So what I think I was saying is that uh, when you are investing, you can invest in an index fund without too much effort, right? You can spend, let's say, one 1 hour a year. You can just go ahead and invest in Nifty 50, and if you do an SIP, you can more or less actually beat the index also by a percentage or so, right? So you will at max you'll spend a year and you will do 13 to 14%, maybe even up to 15% also, right? And as long as you don't get distracted and you don't try to fiddle around with, that should be your baseline. Now let's say you're an active investor, right? You're a very smart active investor. Usually over a 10-year period, beating the index by 10% is a really good number. We are not talking of a particular year, because you can always get lucky, right? But over a 5 to 10-year period, beating the index by 10% is usually a good threshold. Now what usually happens is that if you have to calculate or do the math of is this really productive from a time standpoint, you should take the value of your portfolio multiplied by that 10% or point 0.1, and then divide by the amount of time you're spending. And if you do that math, what you will realize is that you make much lesser per hour compared to the amount of time you spend working. It's the start, unless you are managing family money, and that's a big amount. That's a different story. For most of the professionals, their own savings are much smaller, so the return they're making is much lesser. But does that mean you should not do it? No, right? If this is something which interests you, if this is your passion, then definitely you should do it. But you should be clear-eyed about it, that the reason why you're doing it is because you are interested, and more importantly, the true returns are back ended. They will all happen 10 years, 10 years later. They will become meaningful 20 years from now. That is when all the magic happens. And just like your knowledge compounds and your capital compounds, in the 20th year, even a few percentage extra is a very a decent number. So I think that's what I meant by return on time invested initially in the first. And a lot of people do not, it I think most of you, or some of you who would have followed and heard about Charlie Munger, he talks about having a very long attention span, right? Like, if he was very recently was asked about, how did he succeed, and he said, I have a very long attention span. And that is what this is, right? You should remain committed. You continue to learn, you continue to expand your knowledge, and then obviously the benefits are all back ended. So I think that's where the return on time invested, and how you can think about active investing. Now the second topic which I was talking about was longevity of companies, yourself also as an investor. And when I said longevity of companies, the term which get used often is compounders, and I usually don't like that term for the simple reason that it's more of a narrative than anything else, right? A lot of companies are only obvious that they are compounders from hindsight, and not going forward, right? Things go wrong, the business can go sideways, or the business can just stagnate for years, and you will leave, or you will exit that particular stock. So that's from a compounder perspective, and we'll see how we can blend that particular concept into our own investment style, right? So that was the second thing, which, and third was not fixating on specific heroes. And why, I think there was a question about who you follow, who you don't follow, and all that. And I when I started writing, some of you who have read my blog would know that I used to and I still follow Warren Buffett quite closely. I started following him from 95, 96 onwards, and he was not a household name. The problem of idolizing just one person is that then your thinking becomes very very dogmatic, right? If the guru or the person who you follow blindly, or whatever you admire too much, says you should be doing A, B, and C. And for example, a lot of people who follow Warren Buffett would say buy and hold is a good approach. You will, I'm guilty of that. You will think buy and hold is a law of physics. Any company you buy should be buy and hold, and that's it, right? You close your mind to everything else. Now, for people like me, buy and hold has worked exceptionally well, and it is a very good philosophy which most people would, if want for anything else, should follow that. But knowing the nuance, knowing the context is very important. So that is something which you should, if you learn from everybody, you will learn different approaches, you will learn different ways of thinking. It will make your investing journey also far more productive, and uh, you can do maybe much better also. So that today's session, what we will do is look at different approaches. I like to use the word framework, and I think most of you who may be in the technology space may understand what is the meaning of a framework. A framework is like a set of rules, set of thought processes, uh, different tools, methodologies, putting all of them together to achieve a particular goal, right? So we'll talk about coming up with a framework by using different approaches to investing, right? Or different approaches which are available to us in investing. So for example, value investing, momentum, right? What can momentum teach us? How can you consider momentum when you are building your own portfolio? How can you consider technicals when you're building your own portfolio? uh, how can you think of, there's something called as factor analysis, right? How can you think about what are factors, and how you can think about when you're building your portfolio? And from there, how do you construct your portfolio, how do you reduce risk based on that? And then we'll talk about some examples of how to do that. So let me pause here for a couple of minutes, Prince. Let's see if there are some questions on what we have spoken about before we dive deeper into the different approaches to investing, without going too much into this chart and that particular chart patterns. Will take a slightly broader view as to what these each of these approaches, what do they bring to the table for an investor, and then how you can blend it with blend all of them each other, and how you can use that to select stocks, to hold stocks, sell stocks. How can you can use that to construct your portfolio? So let me just pause here. We can also see whether the audio.
Whether the audio. So, Rohit sir, like basically these days we are swept by the new narratives coming on daily basis, be it new ideas, new ways of doing things. On that front, like how one can condition, or it's more like finding out what not to do, rather like focusing on more like whichever way information is coming to us. So directly, instead of directly acting on the information, we should be, I mean, more prepared in the sense like we what we should take and what should be filtered out. So what's your view on this?
So I think, and I, one of the things which I can, and as we go through this particular session, will, hopefully some of those things will become clearer. If you think of a framework of how you're building your portfolio. So let's say one popular way of how people have started looking at their portfolios, they call something as a core portfolio, and they call something as a satellite portfolio. Now, again, I've usually constructed my portfolio in that sense, but this is a better, or kind of a simpler way of thinking of your portfolio. And your core portfolio are companies which are steady, which you have done a lot of in-depth research, you understand their business model, you spend weeks, months, maybe following that, and you've learned quite a bit about that. So that's something which you will not touch it as quickly. uh, let's say there is a certain percentage you've already allocated to that. Now, ideally, in such cases, you would not want to touch that, you would want to ignore noise around it. So I'm just making this example, right? Again, I think, Prince, you mentioned this earlier in the call, any of the stocks which we discuss are just for educational purpose. So let's say, just for the argument's sake, you hold HDFC Bank, or let's say you held ITC for some time. right? And whatever reason, right, 5 years, 10 years, or you did a lot of work now and you think the company will do well in the next 5, 10 years, right? That's your holding period, at least 5 years. Better to ignore the noise around it, right? Because day to day fluctuations will not change the business model of a HDFC bank. It does not matter if a PSU bank is doing better in this year, right? Because 5 to 10 years from now, the private sector banks, the top private sector banks like HDFC Bank, like the ICICI banks of the world will do better than that. So if that is the space you are focused on, don't bother about it. And then let's say a part of the portfolio is more active in terms of the active portfolio, right? Where you're kind of having a smaller horizon, you're actively trading, you're using different strategies. That's kind of trying to get more extra returns. Think of that as a higher churn portfolio, right? That may have a window of 2 to 3 years, right? So in that case, uh, that's more active. You are constantly trying to improve on that portfolio. In such cases, I usually would suggest ranking all the positions which you have, right? It's almost like a 100-meter race you are trying to run, right? It is not a marathon in that case, if you're really inclined to that. Now, in that scenario, if a new idea comes up, if you the most important thing is to have a mechanism of some sort of filter in your head, right, as to what kind of ideas you will look at and what kind of ideas you will ignore. So let's say you hold 5, 7, 8 companies in that particular section of your portfolio. That's the area where you want to get more active. And to be more precise on your point, Prince, it's very important to start developing or having sort of a framework or a methodology in your head to know what to ignore. I think the one of the most important skills for investors going forward, and we can touch upon it also, the new technologies which are coming up like chat gpt and all of this is going to just expand from here, right? So the most important uh, role for a particular investor is, first he will have to know how to think, how to connect the dots, and what to ignore, right? Because data is more than enough data is available. You can easily go search, often you don't even have to go and meet management. There is so much information which is coming out and it's just increasing, right? So information is there, enough recommendations are there. Your job going forward will be to collect all this information and synthesize and connect the dot and see whether it makes sense for you. So it's more about knowing yourself versus somebody saying steel stocks are good. I think the first question you'll have to ask is, do I want to be in steel stocks? Is that something which fits into my thought process, my methodology? Not because it will go up 3x, because who knows will it will go up or not, but does it fit into my framework? And then second, where will it fit in? Eh, am I looking at it from a 5, 10 year perspective? No, then that's wrong, right? Then maybe it's part of my satellite portfolio. And then what's the approach I want to use to kind of analyze it? So uh, I would say, you first need to know how you want to go about it, then just take the information in and then try to figure out what to, because the information will not tell you what to do. So I don't know, Prince, if this answers your question, or you or somebody else has another. I know it's
I
not
know
very,
it's not very,
but
but
we'll get
we'll
into.
get it. Right, so it does, it does. So Manish, you had your hand raised, so you can unmute and ask your question. Manish, you are still on mute. Okay, or I will ask later on. Okay, so Kaushik, you can go next. Like you can ask question.
Thanks, Prince, for that. Hi, Rohit. I just wanted to understand more on, for example, if you're selecting a company, what's your stage of process that you go and what makes you to screen? Like you told, there are some process and systems that you follow. Can I elaborate more on that?
Right. So let's dive deeper into that. So I think that's anyway the agenda for this particular session. Let's get a little deeper in terms of what how we let's do a first pass and then we'll dive deeper into it, right? So I think maybe answer to your question, or maybe the main topic is going to be around how we can use these multiple methodologies, right? So let's first define a few terms quickly, right? In terms of what these different approaches are. And I know a lot of people may already know about it, but we'll just go about defining a few a few terms, right? So first, maybe let's call it as whatever, value investing, fundamental investing, whatever, right? And what are we trying to do over there, right? If you really think deeply about it, you're thinking about a stock as a business, right? You're thinking, okay, I'm not buying a stock. I'm actually buying a small share of a business, which means my returns will will depend on how the business performs, and the key point being over the long term, right? So it does not mean that, if the stock does you goes up by 10% in a particular month or a quarter, I will do something about it, because you believe in the business, you think over the long run it will do well. So the key point, or for a fundamental investor, is how the business performs long run, and again the valuation, right? Because if you overpay for it, then you're going to be in trouble, right? So from a fundamental investor, and there are different approaches. Some people will say buy at any price, some people will say buy at a reasonable, growth at reasonable price, but those are just flavors of it, right? Like how much you want to pay for buying a particular company. Some people will say I'm a deep value investor, which means you're buying at a very low valuation when the company is not doing well, and things of that sort. But those are just different flavors of how you go about valuing a business, and at how much how cheaply or how much at a fair value are you going to pay. So let's put that as one bucket or one approach to investing, right? And again, keep in mind, no approach is better, no approach is bad, right? It all fits into but an individual investor, how he or she wants to go about it. Second, I think, let's very broadly, and I know some of you may be a lot in depth into technicals, but I'm going to oversimplify it, just to kind of see how you can connect that into a broader framework. So let's talk about what is technical analysis, right? It's more about using, it's more about being able to understand the psychology of the investors or the investor community, right? So it's more like a window into the psychology, right? When you're doing a fundamental analysis, you're not even looking at it, right? You are actually trying to work against the psychology. You're saying the market is wrong, it has undervalued something, I know better, right? But that does not mean you will be right immediately. Sometimes it takes a long time. Technicals, on the other hand, are kind of flipping that equation. What you're saying is, I accept the wisdom of the crowd, or at least the crowd is going to do something, and I need to understand what that something is, right? Again, you're not trying to forecast what they will do. What you're trying to do is you're trying to understand how the crowd is thinking at that point of time, and you're trying to position based on that. Now, how you typically do it is you use the price volume action, you look at the demand supply situation, and based on that you're using technical. So that's very broadly, that's let's say technicals, right? And then let's define what is momentum, right? Now, momentum investing, again, it kind of stands out on its own, but it's at a very simple level, it is like persistency in terms of your returns, or the persistency of terms of price action. So let's say a stock is going up, it will continue to go up independent of you know independent of valuations, independent of the business performance, and so on and so forth. Right now, again, a lot of studies as to why that happens, and we'll not try to worry about why it happens. It's just that it's a known phenomenon, it has been seen, it has been tested. It does give excess returns, right? So that's in terms of momentum. Then you would have heard about quant investing, right? And what quant investing is at its simplest, or at its core, is that you want to invest based on certain parameters, and we all do, whether you're a functional guy, whether you're technical, whether you're momentum. We all use certain quantitative measures, or certain measures which can be set up quantitatively. And a fundamental investor will say, I will invest only in companies which are growing more than 20% CAGR, and which have a debt equity ratio less than, let's say, 0.5. So that's a quantitative measure. So you quantify all your measures and everything, and you invest based on that. So how are these measures identified? They are identified based on back testing, right? They are not based on so instead of appealing to an authority saying Warren Buffett said this or George Soros said this, you take a factor, you test it, and only if it is valid in a back test do you consider it for building it. So you kind of develop a portfolio based on all these parameters. Now, each of these approaches have their own strengths and weaknesses, right? They provide you a view into analyzing or evaluating a market, right? uh, my I think My background, I think, has been that for the almost 15 to 20 years I always focused on value investing. So why did I start going down this path, right? The reason is that in the past, I had a very blinkered view. I used to just focus on value investing fundamentals. But then what I realized is that even then I felt that there were certain gaps in what a fundamental or a value investor you know can maybe, in terms of how he can understand the market, right? So I'm not talking of excess returns, lower returns, whatever it is, right? In how you can understand, and where is that? So for example, right, and I'll again take a name, right? And again, no means recommendation either ways to buy, sell, or whatever, right? But just think about it. I've written about it also on my blog. So let's say, we used to hold a company called as Pyramid Enterprises. It did well for 6 7 years, compounder, etc., etc. And then when the ILFS crisis happened, it suddenly crashed. Now, any such company like a Pyramid or any other company where all of a sudden you see a sudden price action, right? And you see a very severe price cut, and it drops. Typically, when you pick up the balance sheet and the annual report, the numbers are still very good, right? I mean, it's backward looking, right? So it's going to look, cheap on fundamental measures. It's going to look good on all the financial parameters, but the market is telling you something else, right? Now, often, you will be left scratching your head as to what to do, right? Because the numbers are looking very good, it appears cheap, you may even be tempted to buy. Or in the same fashion, you're looking at a company and the numbers there aren't really good, and suddenly the stock starts running up, right? And it's nothing is visible in numbers. So I would be, often I would be confused as to why this is happening, and the numbers will come after 1 quarter, 2 quarter, 3 quarters later, and then you would realize that some of this information has already either started flowing in, or people or investors have started anticipating. Or so in effect, the one individual may not be that smart, but overall everybody, the market as a whole, is forward looking and is able to figure that out. So that's a gap which, which hopefully, if you think using the, and again, each of these are different tools, right? Different instruments. If you look at technicals as a tool, then that is where it's helping you. Momentum, right? Like, how can momentum help you in terms of thinking, right? So let's say you're looking at a company and you say, oh, this has been going up for the last 6 7 months, and I want to hold it for the next 5 years, but it's extremely overvalued. What you have to maybe think at that point of time is, the stock is in momentum, right? And momentum usually will last from 9 to 12 months, and after that, it's quite possible the stock may drop or some. So the returns which you're seeing now could be business momentum, could be stock momentum, and if you plan to hold it for 3 years, then you are in trouble. Which is where I think the whole concept of buy at any price is uh, is flawed if you don't have an exit strategy. Because the only reason why momentum works is that practitioners will have a very systematic, an exit mechanism. It's almost formulaic, right? They will buy something based on a formula, and they will exit as the momentum is dying down. So if you're going to buy something at any price but you don't have an exit strategy, then you're in trouble. Let me stop here, Prince, because we have a lot more to cover in this. Let's maybe take questions on this, because otherwise it becomes a boring monologue, right?
Right?
And
And
we'll
yes. So, Kaushik, can you follow up, or shall I go with my question?
Yes, I have a follow-up. So the strategy is every time you're telling that we can do back tested and understand what the strategy is telling all about. But normally, it's in hindsight, back testing any strategy or anything, the data only compromises on the such a level that it only proves your strategy on an overrated basis, right? But in the future, we don't know what happens exactly. So relying on only back tested, is it good, or some sort of like again you have to depend or at least around 20
Mhm,
30% on
mhm,
back tested?
mhm. So let me answer that question. So see, when I'm talking of the quant methodology, um, I'm talking of taking that mindset. And why I say the mindset, you have to understand what is the foundational aspect of a quant strategy. The foundational thought process, or you can say principle of a quant strategy is: a, investing should be based only on parameters which can be quantified and can be tested based on historical data. If you cannot quantify a particular parameter, management is good, what does that mean, right? you what you mean by what management is good versus what I mean by management can be different. So we will quantify it by saying ROE. Management is good should manifest itself as high ROE. So that is the first kind of, you can say, a principle of quantitative strategy. The second is, it is evidence based, right? There has to be some back, evidence to for that particular variable to be considered, right? And the third is, uh, you put all these variables together but you follow them unemotionally. And maybe a fourth and extended point is that often, these quant strategies work quite well if you can follow them unemotionally, and if you don't really proliferate the number of variables which you're looking, like you don't just keep piling on variables, right? of, like momentum is actually a quantitative strategy with more or less, one or two variables. And see, one of the things which was almost like a revelation for me was, so just stepping back a little, maybe I spent 15-20 years doing value investing, and people who are fundamental investors will look at the like a whole laundry list of stuff: management, competitive advantage, this, that. Like, if you start putting the list together, maybe it is 30, 40, 50 parameters or variables, right? You're thinking, you're talking, doing all kinds of things. And then you look at the momentum strategy. I think I would recommend, just do a Google search, and you'll realize that in the Indian markets, a simple momentum strategy, right? And what is a momentum strategy? As a very simple level, it says you take all the stocks, you calculate their returns, you and I'm again, guys, I'm just oversimplifying it, but just bear with me. Just to take their returns, let's say for the last maybe 6 months, and there's a cutoff period and different, slicing and dicing you can do. But at a very simple level, you'll say, take the returns for their last 1 year, um, arrange them in the reducing order from 1 to 100, pick the top 10 and buy them, right? And there are different variations in that: pick top 10, pick top 20, whatever. And then after next month, or maybe after 6 months, or whatever that cutoff period is, redo it again, sell all these stocks and buy those again. So first thought which will come to your mind is, this, what is there in this? Like, this is such a simple, mechanical, dumb strategy, how can this do well? And the surprising aspect is, it has beaten the index, and it has beaten all so-called fundamental investors for a very long period of time. So when when I read this, the immediate thought process which came up to my mind was that sometimes, as fundamental investors, we overdo what we study in a company. If there are such simple situations or such simple formulas which can drive your performance, then is it really worth, doing all these hundreds of, like models and DCF and this and that? So I think, to your point, what you were asking, right? In quantitative strategy, what parameters to use. I'm not talking of how do you build a specific strategy. I'm saying, how you should use that thought process. What quantitative strategies means is that, use a few simple variables. Try to think in your approach, what are the simple variables which will drive majority of the returns, and try to focus on them, right? Just don't assume that if I find 50 variables, the 51st variable, I've been guilty of that. I've seen people do that, right? After they have analyzed a company, after they have understood a company, they'll go searching for some small secret sauce, right? CEO ka nephew was doing this, should I look? No, that's just, that's not even an important variable. You're just trying to feel, better about it. That's a risk which you can only diversify away, but you cannot take it out, right? So it's not the specific point around the quantitative strategy. It's more around, what is the thought process these, these practitioners bring into it, and how you can blend it. And how I think a fundamental investor can blend it is to reduce the number of things which you are looking at, right? Try to distill your approach into a more concise and a more efficient approach, rather than just expanding and constantly adding more and more things. Let me stop here. Let's see if, this, what I've explained has clarified the question or not.
also have Ishmohit. So Ishmohit, you have any questions to sir, or any comments to make?
Hi Rohit sir, hope you are doing well. Am I audible?
Yeah, hi,
Yeah,
Ismail.
hi. Right. So, so just a question actually, like because been just observing over last 4 5 years as well, is that momentum तो sir सही है, but how do you think about like this? See fundamentals में what I've observed कि problem क्या होती है? कि once we start going deep, then we like even I earlier used to have a 75 pointer checklist. I thought कि it's just particularly useless after like 10 or 15 points. But then there's a purple patch of a company. जैसे फुटबॉलर्स में like this Marcus Rashford today the मतलब he's a Manchester United player that he's scoring so many goals. Earlier he wasn't, so he's in a purple patch. Do you think also companies have purple patches? Because sir अगर किसी कंपनी में 30% केगर रिटर्न मिल गया, so anyways your long term GDP growth is 6 7%, and max profit growth we expect 12 to 15%, and eventually the reversion to mean happens. Do you think blending technicals with fundamentals helps you to catch that purple patch of a company, like we saw in some of the capital goods company recently, we saw one in one of the financials recently? So how do you think about this?
So, I think you hit on a very good point, and that's something which I've neglected in the past. ठीक है ना, वो बोलते हैं ना हर कुत्ते का दिन आता है. So again, I'm not calling companies कुत्ता or anything, but सबका दिन आता है, right? Like one of the, if you're a fundamental investor, you remember the if you have read a book, and it's a very old book, almost all investors swear by it, but it's the security analysis, right? उसमें वो Benjamin Graham writes, right? There's some quote, some from Greek mythology, right? Those who have fallen will rise, and will have their day again, and those who have risen will fall, right, from glory. So it's, I think what you're bringing is, uh, uh, call it cyclicality. So this is how I think, from a mental, like a mental model, you want to call it whatever. Most of the companies, what happens is, it's like a portfolio of projects, products, whatever you want to call it, right? And then suddenly something takes off. There are very few companies like an SDFC bank or something which find something which they can keep repeating for the next 10, 20, 50, 30 years. And if you can find such a business, that's fantastic. But nothing can just keep firing all the time. So they will find a new product, they will find a new market. It's like a particular space they will start exploiting, and the company will start doing well for a certain period of time. Now obviously the market will just extrapolate it to infinity, and then the company goes to that purple patch, as you were saying, right? Everything goes up. You also call it cyclicality. I would say, yes, that's where technicals. So this is how I usually have now started thinking of it, right? So let's say I buy a company and it is doing exceptionally well, right? It's starting to go 30%, 40%. One thing to keep in mind is, uh, the moment a company starts doing so well, it is obviously going to attract competitors, and there's going to be a lot of competitive pressure. So how long can that particular space last, that remains to be seen, right? So at a certain point of time, as the company keeps doing well consistently, the valuations and everything will start going up. Makes sense to start trimming down your position in that case, right? Now, if it is an opportunity where the most often used word TAM and all that is being thrown about, and people will say this will go to the moon, I think you should start becoming more and more conscious about it. uh, Technical analysis, I personally, I think, again, I think we were talking about the core and the satellite portfolio. What I would say is, technical analysis is, if you're a fundamental investor, and again, that's the point which I am trying to think of, you should use it more like a very precision tool, or more around the edges. Like, if it gives you a very unequivocal clear signal, act on it. But if you are a fundamental investor whose window is, let's say, 2 3 5 years, or maybe more than that, then don't act on every little squiggle. Okay, I am seeing a wedge pattern, I am seeing this pattern, it has dropped below 50-day moving average, let me do this, let me, I usually would ignore that if I'm a fundamental investor. By all means, if you're a trader, if you're time horizon, I'll touch upon the time horizon part also. If you're a 6 to 9 months kind of an investor, all the more reason to use it. But anything more than that, only use it around the edges. If you get a very clear signal that something is wrong, the stock has dropped by 40%, it has gone through all the moving averages, very high volumes, like 5 6 things are staring right on the face, at a minimum start lightening up your position big time, right? Because you may be missing something. So I think to your point, Ishmoit, yes, as long as the company is doing well, see that's where these three keys can come together. Company is doing very well, right? So it isn't business momentum. So that's the momentum thought process. The stock is also in momentum, right? So obviously, valuations will not matter in that case. Now, okay, keep riding it, right? At a certain point, I think it will start exceeding your estimate of fair value. It will start exceeding, your, what you think the company can do. Then switch your hat from a fundamental value investor to realizing that, what, this is now a momentum stock. And what happens in momentum reverses in 9 to 12 months, right? So be ready for it. How do you kind of look at it? When will the momentum will reverse? What momentum investors do is they do it formalistically, right? They say 9 months, 6 months later, I will sell. Doesn't matter what will happen after that, and I will go find something else. If you are a discretionary guy and you don't want to use it, then that's where the technicals come in. I will keep riding the technicals, but when the sorry, I will keep riding the stock till the technicals break, but I will not look at fundamentals at that point of time, because I know the stock is way ahead in terms of its fundamentals. It is in the momentum phase, and looking at valuations and management commentary and this story and that story will not help. So Ishmael, does this answer your question? And I think I can take an example also, to talk through this.
Right side mostly like does actually follow up question or actually just observation has been over the years that we actually also see that these sectors go through different stages. Like 2016-18, no portfolio in India was made without a financial. Then
Absolutely.
between 18-20 something other happened. Then between 20 to 22, no portfolio was made without a chemical company, right?
Correct,
or
correct, correct. The
or
fact.
IT company or
Yeah,
a pharma company. Like no portfolio was actually made without it. And currently we are seeing like similarly, 6 months pehle people were talking a lot about hotel stocks. Someone was talking
correct.
about some other type of company. So how do you like? So problem kya hoti hai like to retail investors or in our framework where we generally end up struggling is that till the time we see that the sectors have entered stage two, like we typically call it, and sometimes the valuations are also higher. So first, how do you like assess this thing? And secondly, you know that a company that you hold, but the entire sector has started breaking down. So that is also a very very dangerous sign that I've observed over last 5 years. कि जितनी भी अच्छी कंपनियों का सेक्टर ब्रेक डाउन हो रहा है तो पिटाई चालू होने वाली है. तो हाउ डू यू थिंक अबाउट द सेकंड पॉइंटर? आई थिंक इन इवन इन योर 2 decade जर्नी यू माइट हैव ऑब्जर्व दिस टाइम एंड टाइम अगेन.
So what has happened also, Ishmoit, is that these things are becoming more and more, and that's, I think, that you can call it the evolution of market. This used to not happen 5 years back. I mean, I know, that usually when I say, it almost sounds like, and again, I obviously, experiences also means getting old, and, sometimes, you lose touch. But the reality is maybe 10 years back, maybe 15 or even 20 years back, cycles were business cycles were equally violent, by the way, right? Business cycles were no lesser than what they are now. But my market cycles on top of that have become far more, aggressive. And a lot of it, I think, has to do with competition, efficiency, and some of these approaches which are coming in now. Like every other guy is now talking of technicals, of stage analysis and all that. What does that mean? That means that see whatever we are talking of, it's not any special insight, right? Like if I talk about technical, everybody knows it, right? Which means tomorrow if a stock breaks through, a sector starts breaking down, or if a stock breaks through 200-day moving average, a lot of people will react. So the question is, at that point of time, at all points of time, we have to think, what is my framework and how am I approaching it? Like let's say I'm just, just maybe just as an example, I have bought into a pharma company. I understand the company extremely well. My horizon to hold it is, let's say, right, 10 years. So I bought, if your horizon is to hold it for 10 years, you will buy a company when, like nobody wants to touch it and everybody has run away. So it's like in your stage analysis, it's like in the middle of stage one, and you are okay with sitting around with that stock for maybe another 1 year, 2 years, 3 years. You will patiently accumulate, and then the stock takes off, right? And everybody gets all excited and all gung ho about it, and you maybe bought a 10% position. Now as the stock skyrockets to 5x, suddenly it becomes a 50% position. You know your, you're very clear in your head that uh, I bought it for fundamental reasons and I don't care what others think, but at 50% the stock is too big for me, so you start trimming down. Let the world do whatever they are doing, because you know what, my time horizon is much longer. Or you will say, I don't want to do anything, it will go up, it will go down, but I know over a 10-year period it is going to give me X. I don't want to actively run in and out of it, as long as the business is doing fine. And you will just ignore it. Correct. You will, if the stock comes down by another 50%, you are fine with it. You will hold it for 10 years and you will get your results, because at 10 years it will be, let's say, 50x. So I don't care whether it went up 5x, right? Because I'm waiting for the 10x. So you can either trade around your position or ignore it. Versus, let's say your temperament is 2 to 3 years. You want to jump from sector to sector, and again, nothing good or bad about it. Then in that case, Ishmoit, the scenario which you're talking of plays a bigger importance. You will get in at the right time, and as the stock starts running up, you need to have a very clear risk management strategy. You'll say, if the stock exceeds X% of my portfolio, if the stock exceeds certain valuation range, if the stock gets into, so what I have done from a personal level is I've started putting certain guidelines, or guardrails, if you may, in my case, right? I will think about, if the stock exceeds a certain X percentage of my portfolio, I will look at valuations as a guard, as a range, saying, okay, above this valuation, start trimming. I will think about technical, saying, okay, which stage is the stock getting into, right? And if it's getting into stage 3 and all of that stuff is happening, I'll start trimming down. So then you start putting those guardrails in place. So it all depends on whether your time horizon for that particular stock, where does it fit into your portfolio, right? And what is it that you want to do with it? And if you want to exit in 2 to 3 years time, then by all means you should start thinking of exiting it, but you should not panic once it starts crashing. You should think about it beforehand, right?
Right, right. I think that answers it. So just I think I was about to go somewhere. So just I think for like all the investors who are listening to this, if you are very technically oriented, that is wonderful if it works for you. But I think if those who are very technically oriented, learning some fundamentals will help you a lot. Actually, massively, it will help you because it will help you to identify which companies are over earning or which are under earning. There's a PVC pipes में हुआ last year. A lot of companies were reporting abnormal margins because they were having PVC bought as raw material and prices बढ़ रहे थे PVC के. So this is
Right.
why margins were abnormal,
Correct,
and
correct.
that is zone of danger because fundamentally as well it will reverse, and technically it is like everyone and their families have bought the stock, and it is sometime going to reverse.
Yep.
Similarly, if you're a fundamental oriented investor, technicals can help you to ride the madness, because I know people who bought Tata Elxsi at 700 डीप वैल्यू करते करते और 1500 पे सारा बेच दिया, और एक
Exactly.
बंदे ने 1500 पे लिया, उसने साला 8000 पे बेचा because
Correct,
he
correct.
was riding the momentum.
Exactly. So it's a the way to think about all these things, that these are different tools, right? And this is how I have put it in my own head. Okay. Let's The one variable you have to think is time period. Are you holding this stock? What's your time? And when I say time period, before you get into the stock also. Let's say I want to hold, and again, by the way, nothing good, bad, or ugly about it, right? If you make money, we are all in the stock market to make money, right? वो सब एक दूसरे का जो मजाक उड़ाते हैं, I think that's a waste of time. ठीक है. The point is to learn from, and I think the first step to learning from everybody else is to see who is doing well and who is not doing well. Anytime anybody is successful over a certain period of time, my threshold is, I don't care about what is your age, what is your background, and where you come from. If your approach is successful for a certain period of time, then it is worth learning. Plain and simple. That's the only criteria. Because हम यहाँ पर कोई कोई statement या कोई, there's no moral argument we are making in stock markets, right? ये approach अच्छी है, वो approach नहीं. All approaches have their point of view, right? So uh, how do you break it down? Think about time horizon. Am I a 6 to 9 months investor, 2 to 3 years, or am I a 5+ year investor? In my mind, what I have started thinking is, if I'm a 6 to 9 months or a 12 months investor, again, these numbers are just, I'm just pulling numbers out of the air, right? But I am a 70% technical guy, and if I put in 20-25% fundamental rules or aspects to it, it will just make my performance better. I will know why the stock is behaving the way it is behaving outside of let's say just the technical factors. If I'm a 2 to 5 year investor, maybe it is 70-30 reverse, 70% fundamentals but 30% technicals to understand, or to anticipate some of the stuff, or the example which Ishmoit said, right? Something is suddenly the momentum is breaking, you will get that. If I'm a 5 plus or a 10 year plus investor, सबको छोड़ दो, just pick up the company, understand the industry in depth, in out, go do scuttlebutt, talk to people, talk to management, do all that you have to do, spend 1 month, 2 months, 3 months, right? Forget technicals, forget charts, this that. Valuations make a lot of difference over there. The business fundamentals, management makes all the difference in that. Forget about technicals kuch nahi karega if you're going to hold something for 5 years or maybe 10 years, right? Valuations a little bit but not too much, right? So it comes down to using these tools, but you have to always marry the time element. And I think the area where this whole buy at any price has failed is because if you're practicing that, and you do not know the exit strategy. And what do I mean by exit strategy? You're playing momentum, basically. It's as simple as that. And nothing wrong in playing momentum, but then don't marry the stock and sit with it, because marrying a stock which is in momentum is like, using one half of that strategy, right? It's worse than not doing it at all. I mean, it's worse than, uh, uh, basically, I mean, you would be far better off if you didn't do it at all, right? Don't do the strategy half the way, right? You have to pick up all the elements. If you're going to do quant, then there's a quant mindset I was talking about. But then if you're going to do quant, then you have to do back testing, right? You can't do quant on some parameter which have been not been tested. So anyway, let me just stop here. Hopefully, I'm kind of going into the topics which I'm going to discuss, but I was going to bring the time element into it. So let me just stop here. Let's see if there are other more questions on whatever you have
Whatever you
spoken.
spoke.
So thank you, Ishmoit, for your inputs and great questions. So Kaushik, you can go next. Then we take question from Ravi. Yeah, Kaushik.
Thanks, Prince. Sorry, I just came again once again. Rohit, you spoke about a terminal value, like you actually pointed out on the TAM. So what is your focus? Because my style is every time, most of the time, I look at like, is the opportunity is very big, and can my company dominate the industry to
Right.
get the market share? That's what I look at.
Correct.
So how about you look at this? Because when we are looking, or like my team in my organization try to look at this, we make sure that it might be a small cap, it might be a large cap. It doesn't matter which cap it is actually. It only matters how the management can actually take it, or how return on invested capital comes out to be for us. So
Correct.
how
Correct.
about your thought process on this? I would love to learn, because I actually read 3 or 4 threads from your Twitter Spaces, so which was actually focusing on that. Can you more crystal
Huh.
clearly explain this?
Huh. So what I would recommend is, I think very recently, maybe a year or 2 years back, or recently, there are some videos which have been posted. And this gentleman, he is like, he's a far superior investor than what I can ever aspire to be. His name is Mr. Utpal Seth. I think he is the
You're talking
CEO of.
about the CF that is CFA Forum One.
Right. On for
Okay,
his
okay.
CEO of Rare. So I would highly recommend watching that particular video. So let's take that, the points which he has made, and let's try to blend in a few more things. So point number one, right? If you're going to think about terminal value, point number one is, it should be part of a or you should be looking at that stock from a long term perspective. No point in wasting your time on a stock which you think, again, same thinking, right? If you're a momentum investor, if you're a technical investor, forget about terminal value and all that, right? Doesn't matter. So I'm assuming implicitly the entire reason of thinking about a terminal value is if your time horizon is more than 5 years. Even for a 2 to 3 year time horizon, I often see people talking about valuations. You can do Google search. There is enough research which says valuations do not matter for a 2 to 3 year time period, right? Like a 30p stock, 50p stock can keep doing well as long as there is business momentum. So let's, we'll try to just frame the question in that fashion, right? That the only reason why you're looking at terminal value is if you want to look at a company from a long term standpoint for a 5 year plus period, because that's where the terminal value will make sense. Now, when I'm thinking of terminal value, usually I don't focus too much on TAM. There's a reason behind it, because what, TAM is a very, the TAM has become a very very abused kind of a term. It often, TAM is like, used by, not by companies, public listed companies, because they're not trying to sell you stock, but we have seen that in the VC space, right? Just to get investor attention, they will just start expanding the TAM. Array, is 10 billion enough? Nahi hai 10 billion, to 10, 100 billion, 100 billion nahi hai to, like, often you will find these charts, right, which says India per capita income is so much and so, and once it reaches China's level, I'll honestly tell you, this is a little bit of a story, segue. I used to work in a company, and it is still there, way back, company called Reckitt Benckiser. They make Dettol and all of that, right? So typically, our bosses will come and say, "Are Hindustan Lever is selling 50 soaps per or whatever, 2 soaps per individual in this place. Why are you not selling?" If you go by that logic, then that is the TAM, right? Like, oh, you know what? 2 soaps, everybody uses one Lux soap per month per individual. So the TAM is what, per individual is 12 soaps and multiply by the population, and oh, this is the TAM, go and sell, right? But we would barely be able to sell even 1/100th of that. It was not because of lack of trying, because there's a lot more to just being able to crack that market, just based, just other than the opportunity. So I tend not to look at the TAM, because if it's a small company, if TAM matters if you are like an HDFC bank, or you are like, you are the number one company with 30% market share and all that, right? Most of the times, TAM will not matter if you're small. What matters is, how is the management, what is the strategy they have, and how are they executing to it. So there are companies, let's say there's a FMCG company. We'll just take an example, right? Small FMCG company, this is a regional FMCG company. Let's say it has launched a new product, and it has become successful in one geography, correct? Which means it has a new product, and its concept has been tested in one geography, right? Now it has started expanding into other geographies. So clearly it is in a growth mode, right? And its strategy has been tested in one market. So you want to look at what is management doing to now expand that. It's like, how are they expanding to how are they replicating whatever they have successfully tested in one place. Like, proof of concept has happened. So are they hiring sales and marketing people? How are they expanding? How are they investing on their investments, on their sales and marketing, on their advertising, on their distribution? Same way, software, right? Let's say it's a new product, some company has developed. They found, let's say, 10 customers or 50 customers who are now using this. So now they have started, now they're expanding from there. How are they, selling this particular product? What is the penetration? Which segment are they trying to tap? So more than TAM, I think I would look at the, how is the execution happening, and how is the management, kind of, thinking about it. And I'm more concerned about, has that initial formula been successful? Has it been tested out, and is it just being replicated, right? Like, what, the QSR chains do, right? They'll first figure out the solution to a certain area, and then they do a kind of, a land and expand kind of strategy. So, long answer to your question, but hopefully, this covers, right, how I think about TAM.
Yes, it do covers. I would come up in the line. Take out Prince. You can ask for another question.
Right. So Ravi, you can mute and ask your set of questions.
Yeah, thanks, Prince, and thanks, Rohit, for sparing time for us. Uh, can we discuss more on different sectors, how you view them in terms of investment for a longer term from here? Uh, we can start with the financials. What's your
Hmm.
view on the, say, private banks? It's been a consensus trade in the market. Everyone in the market is bullish about the larger private banks. But what's
Right.
your view, given we are witnessing inflationary environment where private banks already stand at a lack of deposit. They have to fight for deposit. It's not like GSU Bank who have excess deposit already, so they can disclose. So that is one
Your voice
challenge
is
for the
breaking a
private
little bit.
banks.
Your voice
Is
is
it better? Is it
Yeah,
better now?
yeah. Can you repeat
What
your
I,
question?
Yeah, what I was asking, we can, if we can discuss few of the sectors in detail. What's
Hmm.
your view? What's your view on private banks,
Right.
vis-a-vis the condition which we are seeing right now? Say
Right.
PSU banks always had a higher deposit base than what they required for their advances, so they have that
Right.
visibility to grow for next 1 year, 2 year. But
Right.
private
Right. Right.
banks in the inflationary environment, they have to give higher hikes in deposit and garner that deposit. Uh, on the other side, private banks, if we take the 10-year multiple, they are trading at 10, 15% or even 20% discount to the multiple they
Correct.
used to
Correct.
trade. What view
So
you
first of
have
all, I
on
think let
larger?
larger picture, right, on financials. Correct. Hello.
Ravi, you got muted by mistake. Go ahead, please.
Yep. So so first of all, let's, I think financials is a big space, but let's try to break down this particular thing a little more into a nuanced this thing, right? So first of all, there are two aspects to, and we'll do an analysis or thinking from a time horizon perspective and from the different segment perspective. So if first you need to think as to how you are approaching the financial space. There is a long term, like a tailwind or a long term trajectory which financials will follow. And usually, financials grow at 1.5 to 2, maybe 1.5 to 2x the GDP, right? So if the GDP grows, let's say nominal GDP grows, sorry, not 1.5 to 2x, maybe around 1.3 or 1.4x. So let's say nominal GDP grows at 13-14%, overall financials will grow at 17-18%, like everything put together, right? So what you have to think is, how am I wanting to approach financials? Do I want to buy financials or companies from a 3 to 5 year or a 10-year time frame, or do I want to buy it for a shorter time frame? And that's why, I know I will keep harping upon time again and again, and maybe you will all feel tired about it, but I would highly recommend thinking it on those lines, because that changes how you think about a sector and how you approach it. If your view is, let's say, 5 to 10 years kind of a time frame, because you think the financialization of the economy, which you keep hearing about, will happen, and it is happening, will continue to happen, it will play out for a 5-10 year period. If that is the case, then there will be a certain set of companies which you would want to avoid. Because I think we spoke a little time back also again on the same thing, the question around TAM and everything. If you're going to approach, the TAM in this case is big, correct? Because there's a lot of unmet credit needs, right? If you're thinking of that, then you will want to look at a certain set of companies which are doing exceptionally well, which over the long run will gain market share. And what are those, right? As we speak today, unless PSUs can really turn it around, those are the private sector banks, the new ones, the old ones, things of that sort. So you will not really focus as much on deposit cost and the deposit growth and all that, because okay, sometimes it will go up, sometimes it will go down, and banks have a reasonable pricing power over time. Okay. uh, they give or take 25 basis points. The reason why private banks do better is not because you get cheaper. Again, I don't want to paint everybody with a bank or with the same paint, with the same brush, but I would rather go and get my tooth pulled out than go to a public sector bank. And I hope I have not offended anybody, but my personal experience is that they torture you when you go there as a customer. Like they really blow your brains off trying to get anything done. So if that is a common experience where you value service more, you value time more, and you really don't want to go to a public sector bank because of various reasons, private sector banks will continue to do well, right? So if you're going to play that theme, then don't worry about the deposit growth. Think more about what is the past track record of these banks and these financial institutions. How well have they managed their credit cycle through these various ups and downs? Have they gone crazy during the up cycle, and have they then then kind of paid that and more during the down cycle, which means they get too aggressive, let their loan standards slip, and then the whole thing comes down, right, during a down cycle. Avoid those if your view is a 5 year plus view. If your view is a 2 to 3 year, and that's where the cyclical element now comes in, right? Financials usually have quite quite deep or not deep, but they have a reasonable cycle which last roughly around 3 to 5 years. 16 was one, right? There was a whole cycle from 16 to 18. Maybe it started around slightly earlier than that. It peaked in 18, and then we had a 3 year down, right? So we're getting into an up cycle. So if your view is that I want to play this cycle out, and I think sometime back even Ishmoit was asking the same question, if you want to play this cycle out, then where do you get this swing on your cycle? You get the best bang for your buck, not in the steady banks. You will get it in all the the beaten up sector, right? So you can, if you buy a cheap PSU, if you buy a an MFI, or if you buy some of these high growth smaller companies, the bang for the buck will be much higher, right? But the most crucial point in that case is you have to be very clear that these cycles last 3 to 5 years at max. And as the the euphoria in the sector starts picking up, start taking your money and start exiting. So if that is the case, then look at a PSU bank, then look at the smaller banks, right? You buying them at the bottom of the cycle at a fairly low versus or cheap valuation. And as the sector starts picking up and the loan losses normalize, earnings will grow, everybody will get all enthusiastic, then you will get into a momentum phase, and then just keep riding it, and when the time comes, start reducing it and exit it. So financials, it's cyclical. We are slowly coming out of the down cycle now, and maybe the next 2 to 3 years will be good, and you can play that cycle. But then be ready to hop off the train if that when the cycle starts turning.
Right. So,
Understood.
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 so Ravi, if there is follow-up, we can take now, or if there is another question, then we take one speaker in between. It's up to you.
Yeah, yeah, we can take other speaker.
So, Denny, sir, you can unmute and quickly ask your question, please.
Hi Rohit,
Hello.
I am a long-term technical investor.
Right.
I'm 99% technical, 1% is management pedigree.
Mm-hmm.
My experience, last 5 years particularly,
Right.
all my multi-baggers, uh, when I entered, it was more
Mm-hmm.
than 50p. Why that so?
Sorry, come again. When you enter, they what?
They were above 50p, at least 50p,
Huh.
because I was not a part of a crowd.
Correct.
Say, always enter at 52-week high or a lifetime high.
Correct.
So, is it a better strategy?
No, so I mean, you said you are what, 99% technical investor, and how long do you hold these kind of companies? If you say you,
I am holding Asian Paint for 13 years.
huh,
Last 3 months back at 52-week low, I sold because Asian Paint never
mhm,
made 52-week low in 12, 13 years after 2009.
correct, correct. Huh. So if I'm understanding correctly, I think again, yours is a very unique style. I've not come across too many people who who
Uh,
look at. So if you are going to, so I think if you're taking the example of Asian Paints, right? I think
huh,
there are some companies like Asian Paints and others who have been in these very long cycles, right? They started doing well, maybe uh, they've always done well in that sense, right? But over a last 10 to 15 years, slowly they've gained more and more and more prominence, and their P's went from uh, you know uh, again, that's a company which has been, I've known that company for a very very long time. It started off at 15 or 14p. It's very difficult to imagine in 2000 it used to be a 15p stock, and from there, if you draw a chart, it's gone right to the. So there have been a lot of these companies which have gone up. Now my own take on the valuation is that as we have seen interest rates go down in the last 15 years, P's have kind of gone up and up. But if and that's a big if interest rates continue to be high as they are expected, then a lot of this momentum plays, long momentum plays again. So there is a momentum cycle which is a short term momentum cycle, and then some of these have been like long term momentum plays, right? That the piece slowly just kept expanding because the interest rates were going down, right? It's globally 40 years of interest rates were going down. That's why all these companies did quite well. My personal view is that that regime has changed. Inflation, we are not going to get 0% inflation. We are not going to get 0% interest rates globally. India to chalo never went to 0%, but obviously India got impacted by that or influenced by that. But if inflation remains high, right, because of those tailwinds are gone, then seeing those extremely high PEs may not, we may not see those high PEs now, because these a lot of these companies are exceptionally good companies, exceptionally good businesses. You're not looking at the stocks just crashing all of a sudden. But what you may end up seeing, and it happens, right, all these are cycles. You may see that a lot of these really great companies, and I unequivocally can say these are great companies slowly go through a correction, right? You will see them go slightly down, then slightly up. But then if you look at it 5 years from now, you may not make that great a return as you have made in the past. So being able to buy at a high P and be, that was a window from 2010 to maybe 2020. I missed it because I'm an investor who usually gets very sensitive about high P, but maybe that those times are gone. So Denny, I think that's at least my view. Again, who knows what will happen, but I think those
Just
super high P's may not last. They may last for short periods of time, but you may not see them last for very long periods of time.
just one question. Sorry.
Mhm.
Uh, is it dangerous to add fundamental with technical?
No, no. See, so that's the thing, right?
Lastly, execution matters.
Sorry, come in. What matters?
Execution of order matters. It
So
is behavior rather than anything.
uh, see, nothing is dangerous. You just need to know what you are doing, like, and why you are doing it. So there
Right.
are, and I'm sure if you have been successful in technicals, there is no harm in it, right? And if you have been successful with fundamentals, the only thing what fundamentals give you is, if you think of it, they tell you the why behind the chart. The chart is,
Right.
you've seen certain things, certain patterns in the chart. The fundamentals will tell you why that is happening. Now, do you want to know it or not? Maybe you don't care, right? If the chart patterns are telling you to do something, if the stock suddenly has dropped to the moving averages or whatever high volumes is that, you will execute. You don't care about why it is happening. Let others care about it. Nothing. Maybe you want to understand. Okay, then you can understand. The risk always of fundamentals is that fundamentals always come with stories and narratives, which is why I know a
Right.
lot of people who follow technicals do not want to learn that, because they say, I will get influenced by the story or the narrative. So don't tell me anything about the story. If the chart is telling me something, I will do that, and vice versa. But I think sometimes the place where fundamentals help is that prices can break for reasons which are not entirely related just to the business itself, right? Let's say if all of a sudden there is a certain global event or a certain market crash or something, and your stock just drops a little, through some preset parameter which you have. Maybe you want to understand what is happening behind it and take a more nuanced view, right? Maybe you do not want to exit the full position. You will say, I understand the fundamentals. There is a slight issue in terms of the chart patterns. Let it drop. I will reduce my risk, but I'll still hold it because I think it will recover from there. So you can bring that element into it, but it's not important if you have been successful at technicals.
It is more individual.
Yeah,
That
absolutely.
behavior is more individual.
Investing is
So
entirely individual. I mean, I know of
I agree.
people say the typical average investor. There's nothing called as a typical average investor. The only typical average investor is somebody who invests in the index and then just does not look at it. That is the
Right.
only typical average. Anybody who is doing active investing is not the typical average investor, because we all bring our personal experiences, histories, likes, dislikes into the picture. And these are tools. you know Understand and learn all these tools, and then pick and choose and decide, right, how which tool you want to use, how much you want to use, where you want to use. That is a lifetime's journey.
Thank you very
Thank
much.
you very much. Thank you,
Yeah.
Dennis, sir, for your question. So Rohit sir, like if we talk about infra as a space, so how you
Right.
see, I mean, do you see any changes, like if we talk about the past, what had happened in the history in the sector, and
Right.
if we compare like what's happening these days, do you see any segregation, or it's more or less the same things are happening again and again?
No, I do see some change. So one thing I think, if you just take the broader picture, I think India has gone through its own learning curve of how to put infra in place, right? Like for a very long period of time, and those of you who are, slightly older, would know what I'm talking about. uh, there is actually, so there's this thing, right? There's this concept which comes as, escape velocity, right, which you have heard in physics and all of that. So let's maybe and again I'm giving a little winded answer so that you understand the context of what I'm saying. If you break down our history, almost till you know mid to late 90s, India was hardly bothered about infrastructure, right? Like it used to not even feature in the I mean, everybody used to complain there are, potholes, and there is this is not there and that, but you would not see much action from the government at all, right? Barely any investment used to happen in infrastructure. Then from, again, I may be getting the dates wrong, but then, early part of 2000, this whole thing started coming up, right? That, as a country which is doing well has to put in infrastructure, right? And then the government tried a bunch of things, right? Initially in the first 10 years, right? They introduced a bunch of, reforms. They started bringing private partnerships. A lot of companies jumped in, but it is like, the growing phase, right? Growing phase for a country, growing phase for a sector. A lot of things had not been worked out. We did not know how to manage land acquisition. A lot of fly by night operators got in. The sector went ballistic. So by 2008 we had full euphoria, because, the country and companies and investors, everybody thought we had all figured out. And the same, abused word of PAM came in. People said, 100, 1 trillion opportunity, and this and that. And nobody kind of, really thought about what risks are there in that sector. Like, how do you make it work? And then all the risks came up, right? And then the next 7 8 years, the entire sector, entire country kind of suffered through it. But what happened through all of that is that slowly, as a country, we have worked through our problems one by one. And again, none of this is a political statement, and I'm not wanting to go over there, because my personal view is that there is this whole overall theme where, irrespective of the political parties, as a society, as a country, we have solved some of our very unique India specific problems, right? We've all heard, right? Land got acquired, and, then compensation was not given, and then the Supreme Court stepped in. So that you can call it, that we as a country have slowly started figuring out the how do we solve these problems, right? China, we keep saying China model, right? China has solved it in its own way, right? The central government can issue a rule, and that's about it, right? There is no questions asked, because it's a communist country. Property rights are not the same. India is not like that, right? India has property rights and all of that. So it's solved in its own way. But now that solution is coming in. So those of you who have tracked the sector, you can now see that with the road construction companies, with, the the whatever water this thing companies and all of that, they are able to work with NHAI, they are able to work with all these companies, and they are able to launch a project, in a much more timely fashion. When there was COVID, the government really stepped in and figured out solution of how to manage the how to they help these infrastructure companies manage their cash flows also quite well. There were certain deferment of cash flows. None of these companies, went, if you read through the con calls and everything, all these companies, got quite a good support. They were given deferment. The government actually gave them compensation, right? Okay, you know what, if the project is going to get delayed, we are not going to penalize you. In the past, often this would not happen, and companies, their cash flows will get stuck up and all that. So government actually came up with new mechanisms by which they helped all these infrastructure companies actually manage their cash flows much better during the COVID period. So in the last 10 years, as a country, we have solved a lot of our problems, which is why you're seeing an increase in the velocity of execution. And when that happens, right, which companies does it help? Just having a big order book does not help, right? You should be able to execute it. So all your infrastructure kind of your construction companies, the KNR construction and Dilip Buildcon and all those, they can execute orders much faster, PNC Infratech and all that, right? So that helps their cash flows, that helps their return on capital, that helps their various metrics, they can grow faster, right? Again, with the government having figured out the solution, they can keep adding more and more projects, they can build a heavy pipeline, that is working. And then you are seeing far more investment from the government side also, right? It's not just all talk, right? It's all coming out into the budget. By figuring all of this out, they are able to launch the projects on time, they're able to get private sector to execute on time. And as this starts happening and as citizens start seeing the real infrastructure come in front of them, that will become our baseline, right? Like if you see a metro coming in your city, can you reverse it, right? If you see a metro, let's say in a Bangalore or a Bombay, the guy in the smaller town will say, why not in my place? And then the other guy will say, no, why not in my place? They will start slowly demanding, right? So I think that threshold has been crossed, Prince. That again, the reason why I gave you this long-winded answer is that if you look at a 10 to 12, 20-year history as a country, I think we have slowly, again, there will be cycles, we will go through up and down, but I think the trajectory is going to be upwards, right? We will continue to build infrastructure at a very good pace. So I actually am quite happy and impressed how overall we as a country are developing our physical, and our digital infrastructure is actually world class. It's way more than what a lot of other countries have.
I think that's an
I think
under.
that's an underappreciated story about India, which is really going to play out.
Right, sir. So moving on to next question, that would cover two three aspects. So basically, we discussed the diverse approaches. So
Yeah.
how easy or how difficult is integrating these into investment thinking? And like most of the retail investors who basically start, and they are basically trying to find out the what we say, people who have some what we say, renowned people or some expert, and they blindly end up cloning their strategies and end up basically the decision making in this process gets disturbed and they end up losing their money, right? So the broader question is like, when it comes to cloning, so how one can do it smartly, and on the top of that, decision making, which is very important in all facets of life. So how one should view decision making as far as markets are concerned?
So I think first of all, I think my personal suggestion is you should clone or you should follow people from how they do it, but following specific ideas is not a very good this thing, because the reason why somebody buys a particular stock will be very different from why you end up buying it, right? And at a very very simple level, a person buying a particular stock may have nobody's going to tell you what is their implicit time horizon. I mean, there is this implicit time horizon, right? Some people usually try to hold stocks for 6 to 12 months or maybe 2 to 3 years. Somebody may have a time horizon for 10 years, right? How do you know that? There's no label when somebody buys a stock, right? So you need to see whether that particular your time horizon matches with what that person is doing, right? So because if a person is buying for a 10-year period, he will be comfortable with the cycles, you will get nervous about it. So if you're deciding to clone, be very particular about it. In terms of decision making, I mean, there is, it's a journey, right, Prince? So that's the thing, right? You will never, it's not like one fine day you will realize, okay, you know what, I'm now an expert, I'm all done, end of story. It's always slowly you build, you follow others, you learn, right? My suggestion would be, take all these diverse approaches, and it's not that complicated to understand the approach per se. If you really just spend 1 month, you can understand all these, right? Like you can pick up, and we can share these name of these books later, like technical analysis, right? You can pick up one or two books, read that. Momentum, there are two or three good books, you can read that. Fundamentals, you can read that, right? Think of all of these as tools, right? uh, pull Understand them, make notes, write about them, think about it, right? What do these tools? Then the bigger work is, okay, what is your mindset? Like how do you what resonates with you? Are you a buy and a hold kind of an investor? Will you hold for a much longer time? Then dive into that particular approach, right? Learn more about it. For example, I have a value bent of mind. I've always, I prefer to buy a company and hold it for the longer term. So for me, understanding the business, understanding the sector, all of that is important. Why do I look at technicals or momentum? Because it gives me an additional view into what is happening. And in some cases, sometimes, not often, but sometimes it will influence my decision. So, like you were saying, right, decision making. So, a technical analysis will help me make a decision around the on the extremes. So, what do I mean by extreme? Let me give you an example, right? Let's say in the past, again, no recommendation either ways. I was quite interested in exchanges, right? So, IEX, right? The energy exchange. It appeared very good, a good idea, all of that, right? So, we were invested in it, right? And then the stock went ballistic. So, I invested at a fairly higher valuation than average. It was moving. It was above its average, valuation, but then from there it went parabolic for a certain period, and at a certain point of time it was selling at 100 times earnings also, or maybe it was 100 times earnings or something. So at that point of time, you take your fundamental investing hat off and think like a technical slash momentum investor. The stock makes no sense from a fundamental standpoint, but there is a reason. You can think through it like a fundamental or a moment, or for a technical or a momentum guy. What you're thinking is, stock is in momentum, people are buying because it is in momentum, and you can keep riding it till it is in momentum. And how do you know when to exit? What decision can you make? Look at the technicals. And at a certain point of time, there is this whole concept of a parabolic blow off, right? When that parabolic blow off happens, you exit the stock. That point of time, your decision making has switched from one approach, one methodology, to a different approach. You're now thinking like a momentum investor slash technical investor. So look at all these tools, learn them, and then be flexible in terms of understanding which tool to use when, right? How to switch hats. Again, it's a journey. Slowly over time, you will, as you keep practicing it, it will become second nature for you.
In the last conversation we discussed about the SME space, and we see often people talking about this space. So,
Mhm.
on the risk reward side, how I mean the whole space, you see the whole space from the risk reward point of view, because
SME, the small
normally the yeah.
small caps, right? The real tiny caps, micro caps. That's what you're saying, right?
Right, right. So,
Okay.
so basically, when there are too many talks about that this ought to go and there is lot of value, so that is the time to get cautious most of the time. So, what's your view on those lines?
Again, I have a little bit of an extreme view on the small and the SME space. Okay. Uh, so there is this concept which, I think over time I have kind of slowly come down to it, that there are some things, which often, independent of what happens, they are not worth the effort. Okay. Which is where, when we spoke about return on time invested, like people talk about, okay, investing in IPOs, right? Like I've said on Twitter, I've put a post also, and people say, by the way, if you do this and this, it works. And I don't deny that. If you can find the right IPOs, a lot of wealth can be created. And when I say IPO, I'm saying you invest, in an IPO, not after 6 months, 9 months, after a couple of months. So it is like any other stock, right? Or you don't do FNO, right? Now there are obviously always exceptions around it. A skilled practitioner focused on it can do well. The question is, are the odds with you or are the odds against you, right? And as an active investor, do you really have the time? And the other bigger point is, why are you doing it? Why should you invest in an IPO? Like, you have to ask yourself, what is it's a tough area to make money in an average IPO. So what is the delta skill you are bringing into it? It is a tough area to make money in FNO. So what is the extra skill I'm bringing? Same thing around the SME space. Out of 100 companies, that one or two companies will go to the moon. Every successful company was at one point a small company, right? Maybe it was listed, maybe it was not. But the ex ante means before the fact, right? That's the meaning of ex ante. Success rate of these very small tiny micro cap companies is like low single digits. So which means out of the 100 companies you look at, 90 companies will go down the drain. Do you really want to spend time on that? And what so answer to that question for me personally is I no, I don't want to, right? So that's point number one. Point number two is for this space, the skills required to analyze these companies is very different from your typical companies, because these are early stage companies. They have a concept, or they have a product or a service which has worked in a very limited sense, right? So they are still scaling from there, so very different, right? Scaling is not easy. So you need to have a very in-depth understanding of the management. Like you should really know the management, right? Forget about what they are trying to do and what TAM is there and this and that. It's almost like venture capital investing. Can you trust the management? Can you trust their execution skill? So that's the skill which you need. And third is, there's a lot of fraud in this space, and usually a lot of froth when the market goes very high. So if you put all of these things together, right, the odds are against you. So unless you can answer this question that I want to learn this and I want to pursue this for the next 5 to 10 years and maybe think like a venture capitalist investor, then it is really a very it's a very lucrative space. But don't expect overnight success or very quick wins in this area. You'll have a lot of heartburn before you really hit the jackpot. But yeah, it's a place where you can become extremely rich if you get a few right, but you have to be
But you
ready
have to
for
be ready. Right, sir. Lately, have met Ashish Chugh, sir, and he got similar views which you just discussed. Yeah, Kaushik, you can quickly go with your question, then we go to Ishmohit again. Yeah.
Thanks. Rohit, I just wanted to understand. It's like normally while investing, if ROC if your ROIC surpasses your ROC, and you know that the company is doing some kind of capex investments in
Mhm.
the new business, and the growth, you think that the terminal value for this business is slightly bigger than the current business. So, how do you take an approach over here? And
See, I
you saw that in last 1 year, this has also been proved for the kind of actions that the management is taking. So you have some kind of data to support you.
I think you more or less answered your question, because the key problem was the ROIC on ROC is a math. It's very simple to figure out, but it will not tell you much. You can get an ROIC which is higher than R. That's the thing with all some of these quantitative measures, that they will appear good for reasons which are only temporary. So but the second part which you mentioned will answer your question, that if you think the terminal value is good. So think of, let's take an example, right? Let's say uh, in healthcare, right? Let's say it's a hospital, right? Well established chain, lot of hospitals across the country. In a steady state, they are making 25, 23, 24% kind of EBITDA margins, right? That healthcare is a steady space, has a high terminal value, right? Unless the government decides to do something very very wrong in disrupting the economics of the business. Most likely, the terminal value is robust, right? I mean, only in an extreme case, I think the government also realizes that it needs private sector, and it cannot just completely kill the private sector, right, by taking short sighted this thing. So we can say terminal value is solid, and it is improving. Why? Because the management is investing in the brand, it is investing in technology, it is investing in expansion, geographic expansion. So the terminal value is good. Now when it is doing a brownfield capex, right, that's where you can say ROIC is higher than ROCE, because it's making, let's say, 15 or 18% ROCE, but by doing a brownfield expansion, the ROIC is more. It is bringing, let's say, new automated tools, let's say the Da Vinci robots to do surgery. ROIC is higher. It's bringing new doctors. It's investing in digital technologies. ROIC is higher. So in that case, the answer is that if you think all of these positive actions are happening, subject to your risk estimates, and obviously valuation and all that, you will start increasing the position, right? Because that value is getting added, and that value will surface over a period of time. It will not go parabolic now because these are steady sectors, right? It's not a cyclical sector. So then the natural, if you've done all this work to understand it, then you can always raise your position size. I mean, that's the answer. But again, don't expect fireworks immediately. It will play out over a period of time. Slowly keep increasing your position as you get more and more comfortable, and you'll be rewarded in the long run. I think that is what usually happens.
Right. So, Kaushik, any follow up or you got your answer?
I got my answer, but another different small hinge on that. For example, if the company is currently in a commodity business and they are actually doing an value addition, that's what I call it as something like an ROIC for them is pretty greater than the current business of ROC.
Mm-hmm.
But they are actually trading at an abnormal valuations. With the current business, what they are
Cheap.
thinking.
You're saying
So,
cheap, right?
yes, abnormal cheap valuations. Yes. But when it comes to like their cash flow, it is like being to the north of 50 percentage. So is there anyone missing onto
You're
any
talking.
point over here? Like
Are you
I'm
talking
talking
about?
about CFO divided by market cap is
Are
greater than
you talking
50%.
of pure manganese or something?
I don't want to name their company. Yes,
Okay.
something very much related to some industry which is currently.
No, that's fine. And I know. I mean, and we'll not get into companies because we are not here to discuss about stock ideas and start giving recommendations. Again, uh, I'm part of an advisory and we are SEBI registered. So obviously, I'm not in that business of giving out stock ideas on a Twitter space. So uh, with cyclical companies, it becomes a little more tricky, right? It is not the same as a steady growth this thing, because what happens is the fundamental parameter, and again we'll just talk about the commodity companies as a whole, but every commodity is different, right? So with cyclical slash commodity industries, there are two variables which you have to think of. One is what is the duration of that commodity cycle. Steel has a different commodity like duration, right? Top to bottom, if you start looking at the chart, top bottom, there's a different duration of commodity cycles in a steel versus oil versus cement. I would not call commodity, uh, versus sugar versus anything else. So you have to look at the time aspect to it, and you have to look at the pricing part of it also. A short cycle commodity, what causes a commodity cycle to be short? Where you can add capacity into the industry much more rapidly versus where you can add it slowly. So oil, for example, is a good area which you can actually research to see that it takes a very long time to add capacity into the oil and gas industry. Finding a new oil field takes a very long time. Finding new iron ore mine takes a long time. Adding a new steel plant takes maybe 4 to 5 years, 3 to 4 years. Increasing capacity in the sugar industry is much shorter, right? So you need to, when you're saying you're investing and making value added this thing, you have to look at the commodity cycle duration also. A cycle with a commodity with a low duration is a more risky one, because as you are adding investments into your this thing, you have to look at the overall and sector and see, is the sector at the bottom of the cycle and is the investment happening at that time, or is it at the top of the cycle and is it happening at that time? Because at the top of the cycle, a lot of capex will happen, the valuations will be very cheap, and it will appear like a very good idea to add it, right? But that's a dangerous time because it's backward looking, the cycle could turn. Versus if it's a long duration commodity cycle. Let's say it's like oil, oil and gas refinery, right? When you're adding refineries, it's not easy to create a new refinery or add capacity in that. There you can be a little more confident that the management is doing all these value added investments, and there is enough time period for it to play out and I will get benefited. So it's a little more nuanced in this case. You have to look at what is the nature of the commodity, what influences its pricing, because pricing makes all the difference in the profitability of that industry, and what is the duration of that particular commodity cycle. So again, you'll have to talk about, you have to get a little more specific in terms of what industry it is, and then only you can talk about it. You can't really paint it with a common brush.
Thanks, that answered my question. Thanks.
Yeah, yeah, Rohit.
Any
Over to
questions before we get into more into the framework itself, or do you want to jump?
you. Yeah, yeah, we can.
Yeah, Rohit sir, like two questions. So first was uh, specifically linked to like I think I remember I just asked you like some 20-30 minutes ago was a question on cycles. So do you
Mm-hmm.
think in last 2-3 years because of lockdowns, companies building supply chain security, then
Mm-hmm.
companies actually मतलब 6 से 9 महीने का stocking up करके रख रहे हैं, and then
Mm-hmm.
also specifically like जो like one of the online e-tailers in India which also saw like sales booming during like the COVID lockdown. Do you
Right.
think also like cycles got accelerated because of that? And second was in sectors like defense, where
Mm-hmm.
you structurally know that their CFO to EBITDA, like their cash conversion or CFO to EBITDA conversion won't be more than 30-40% because at
Mm-hmm.
all the times it's like blocked in working capital. Fixed
Mm-hmm.
asset terms तो अच्छे ही होते हैं. So in such a sector, do you think that this sector like deserves to trade at a discount as compared to other sectors? Because if your cash conversion is poor over a really long period of
Right.
time, either you'll have to keep raising equity or you'll have to keep taking debt. So
Right.
these two questions, and also third one, like in your advisory structure only, have you ever planned of like opening a techno funda type structure as well, like what Intel Sense is doing,
Mm-hmm.
or just a long term approach? So
Okay.
three questions.
Okay. Let's start with the first one, the cycles, right? Again, just my view. I think we are all seeing the same data, right? My personal view is that think of a mental this thing, right? You There is a still pond and you drop a big stone. So there is a big wave in that, right? And then the wave will go up and down and up and down, and then slowly it will subside. So in my personal just my personal view, I think it was like a big body of water, a big stone got dropped, and the cycle, these major you know waves got created, right? Up down up down. But that incident is slowly going away. If you look at it, initially, boom in the digital space, demand got pulled in. Everybody thought it was permanent, but demand got pulled in, and the demand got pushed out in the other spaces. Then digital is normalizing, demand is going up. So my personal view is that the shock which came from COVID at a global level, right? It initially, I would not call it a business cycle. It just caused a lot of this whipsaw, right? Suddenly we had shortages, so we had huge demand come in, then the shortages turned to boom, then it is going to bust. So as times pass by, we will see a normalization of the normal business cycle. The business cycles are still there. This was just, I don't think the overall business cycle got accelerated. I think it got just, it went into this whole uh, up and down boom, like up down, and slowly, like, once you have dropped this stone, right, the water first goes up down and then slowly it settles down. So I think that, in the next couple of whatever years, maybe that will happen. So that's part number one. Second, I think, to the from a business cycle standpoint, I think there is a longer term kind of a trend which seems to be happening, which all of us are aware of and are seeing, is the whole geopolitical thing, right? My personal view is, again, I don't think this is a short term thing, right? And I think, the word for that is, and I may pronounce this wrong, Thuk- so there was this historian in Greece, right, who wrote about, when an emerging superpower challenges an existing superpower, it causes a lot of, it can lead to war, it causes a lot of chaos in the world, right? And we know China is rising, challenging US. That is going to in turn create its own dynamics, right? And it is creating own dynamics, right? It is causing reconfiguration of the supply chains, it is causing a lot of volatility. So that is the other element which is coming in. And I think, that may not change the business cycles, but that is causing a reconfiguration of a lot of global industries, right? So that's another theme which we are seeing it play out, right? So overall, I think the COVID impact is slowly dying away. We are seeing more steady reconfigurations of supply chains of industries based on what China is happening. So we have to see, which industry, where all of this is happening, and how this all plays out, right? But I think the whole up and down from a COVID thing will slowly settle down. It is already settling down. So anyway, that's point number one. I think around cash flow conversion to the whole EBITDA OCF to that for defense companies, uh, I have a slightly different view on it. When I hear of people saying, good company has cash flow conversion of X percentage, my what my thought process, or what how I think, is that it is saying, kaddu karele se acha hai, ya potato is better than whatever bangan or whatever. Doesn't matter, right? We are talking of two different business models. What do you mean by better and worse, right? If an industry, it is like saying 2% operating margin, 4% operating margin is bad. Can anybody say that it is good or bad? Depends on the industry, right? Walmart has built a $300 billion enterprise on a 4% operating margin. So is it bad? No, because that is the business model, right? They operate on very high inventory turns, and they make a very high return on invested capital. So it works, right? So why is 4% bad? And a 20% operating margin also can be bad, right? It all depends on the business model. So for defense companies, it is the nature of the game. If you are very uncomfortable with low cash conversion in a particular cycle, then don't look at infrastructure companies, project companies, and don't look at defense companies, because that will always happen. Working capital will always be elongated no matter what. The point to, or the question to ask is, from a mental thought process standpoint, think of these defense companies like your road construction companies taking projects from the government, NHAI, this, that, whatever it is, right? And think of it, will the money come back in a reasonable period of time? Now, it is not going to come back in 20 days, it is not going to come back in 30 days. It is going to take 250 days to 300 days. What is the trajectory? And I think when we were talking of infrastructure, I think that's what I was saying, right? In the past, the government, and even now also, the government was one of the worst, payers, or your money would get just stuck. We know horror stories of companies which have worked with the government and have suffered big time. I think, and I could be wrong here, I think that mindset is slowly changing. If the government wants the private sector to be a participant over there, they cannot just keep torturing these private companies, right? They have to be reasonable with them, allow them to make reasonable profits, not some phenomenal profits, but don't kill them also, right? Be there some, and I'm seeing that in the other sectors like road and all of that. Sensible bidding happens, money comes back in a reasonable amount of time from NHAI and all these, then, and they are supporting the sector. So if that happens in the defense sector also, I think these companies will do fine, but don't expect an exceptional cash flow cycle. That's the nature of the business, right? So does that answer your question, Ishmoit, on the second point?
Yeah, it does, but just to take it a bit broader and like just across the sectors, we have seen that companies sometimes they hold inventory as a business model. Like they're willing to hold inventory for their
Mm-hmm.
B2B clients, and then they end up growing. And then we see after like one of the companies which listed, I think 2019 may list to other, like they keep coming up with like they keep diluting equity to keep funding capex and stuff. So and
Mm-hmm.
it ends up becoming like a treadmill business model. That is
Mm-hmm.
which becomes very very risky. Like how do you
No,
think about this? Like
that is true. So all these companies, right, uh, which need, so the thing is, so again, same point, right? It's a, let's say a defense company has a 200, let's say 200-day working capital, right? Mostly in inventory plus debtors, right? So first you have to look at, okay, what is the return on capital? Now that capital in some companies goes into a plant. If a cement plant is put up, right, it's a huge capex, right, goes into the plant, right? And every time when you working capital is small, but the capex is there in physical assets, right? We don't call that a very bad business, because every time you want to grow, you have to put up a new plant, right? Same way in a defense company, the capex is not very high, but the working capital is where the money goes in. So the question to answer is, will they get the money, will they be able to at least maintain that particular working capital cycle? Will it get to a point where today it is 200 180 days, tomorrow it will be 200, and then sometimes they will get the money, sometimes they will not, government will keep dragging their foot, not give payments on time. things of the moment that happens, that means, whatever numbers you are calculating is all out of the window, right? You may be calculating 25% ROCE, but you know what, that 25% is, it makes no sense, because your debtors are not good, right? You will not get your entire money back, because बोलते हैं ना, government चिक चिक करेगी पैसा देने में. So in that case, but having to put capital to grow, very few businesses don't require capital to grow. Most businesses, right, whether it's a cement company, whether outside of FMCG, it's just a matter of where that particular, outside of the intellectual, whatever IP related businesses, like maybe pharma, or uh, even chemical companies need money to grow. So if a company is able to, let's say, earn 25% return on capital, even in the defense space, right, all that it is doing is it will take all its cash flow and it can grow at 25% in that space, right? The point being is, are the debtors sound or not? Will they get their money back, right? If they're not going to get that money back, then they're not making 25%, which means it's a bad business, right? If they're growing at 40% and making 20%, doesn't matter what business you are in, right? If you make 20% return on capital, and if you're growing at 40%, it's a good business, but you will have to put capital in, right? Which is what often happens in banking, correct? You make 15%, but you have to keep adding capital in it, right, to grow. So
Right, right. So sorry, like one last question, because you've already covered the spare hospitals as well. So in hospitals, we've looked at the super specialty, like your oncology care and the children care hospital that was recently listed.
right.
And so looking at the payer mix between the two, like oncology for a fact will always have higher scheme patients, because that's one of the most rapidly growing sad disease. Like it will always have 25 to 35% scheme patients, where again
Hmm.
problem was receivables and everything could start. But in your child care hospital, your payer mix is like malab the best that could be there in the hospital industry. So, to like, how do you think about this basically dichotomy between the two? Because एक hospital का मतलब, even though because we are looking at a sub segment of super speciality, so how do you
Hmm.
think this?
So when you mean by child hospital, it's all ailments related to children, right?
Right, right. So it's just basically for treatment of children, multi speciality hospital, just meant for
Multi-speciality children versus oncology, right?
right, right.
So uh, the way at least I'm thinking is oncology. See, both the spends are spends which, where the price sensitivity anyway goes down as much as it can, as much as you can afford it, right? Like if you have the unfortunate, this thing of having to go to an oncology, this thing, which means within your personal limits you will spend on the best possible this thing, right? And I think it's rightfully so. The good hospitals are the ones which will not try to pull every money, try to drive, the highest possible margin and take benefit out of your misery. They should just make decent margins, decent return on capital, so that they can keep growing, but the patient also benefits. Same way on the child also, right? Very very emotional kind of a decision. But I think from a child, this thing, it is a little more flexible model, if you may, right? Because let's say on the child hospital, you instead of it I don't want to make that example, but obviously I have kids and I have a pet also. It is like what you would, let's say, spend on pet, you will spend a little more just because you can, right? You are not being forced to, but you just want the best of best, right? Like you go to a multi-speciality hospital, it's not a very serious condition with your child, and if they charge you a slightly more, but they give you that comfort and that feeling and all of that, you can charge a little more than what you could normally charge. In oncology, you are anyway, the person is anyway, in a very bad situation in their life, right? So over there, charging over and above what maybe a moral argument to charge is a little difficult, right? So I think it's more like a discretionary spend slash emotional spend on the children side versus on the oncology side. On the oncology side, I would say the focus for the hospitals will always be on giving the best outcome at a much more reasonable price, because it's anyway a very high spend kind of this thing. On the multi-speciality children side, as long as the brand image and everything is good, if a parent goes there with the child just suffering from a cold or cough or some little bit this thing, they can charge way higher than the cost of the service itself, and the parent will not mind, right? Instead of 500 rupees, if the hospital charge 600 rupees, again, I don't know the exact price, so don't go by the number, but they will not mind for that extra white glove service and a good feeling. Oncology, you know what, the per this rate is so high anyway, that trying to charge 10% extra will really stand out. But again, I'm giving a little bit of an outsider's view. I've not really dug more than that into it, Ishmael.
Right, right. So actually, I won't take much more time. So this last question link follow up on this. So when it comes to sustenance, because you've read this hospital industry, we've seen one part of the industry in multi speciality who are saying that मैंने इस महीने 50 liver transplant करा, I made so much money. Then someone is saying I did 80 liver transplants, I made so much money, my ARPOB is going up. Then on the other part, you see other entrepreneurs who are saying that we are not really focused on ARPOBs, but we are really focused on bringing the throughput out by doing like more and more surgeries, by bringing down our like average length of stay days.
Right.
Ideally, malab, just looking at from an ethical point of view, the latter might be the better way to run a business, because it
Hmm.
doesn't involve the regulatory scrutiny of the government.
Absolutely.
How do you think about this? Because you have read the entire sector, I
I
believe.
I'm more than 100% on the second point, both from a selfish as well as ethical. So two parts to this question. Let's say from an ethical standpoint, right? That answer is very simple. We'll say, you know what, you should, make reasonable profits. Look at what happens in the US pharma industry, right? Like they'll, khoon nikal lenge till the last drop they can pull out of from your body, right? It is like, the old joke, right? Oxygen jeene nahi dega and all of that, right? Like, they will keep sucking blood out of you till you die. They will not let you live, but they will not let you die also. Like the US, healthcare industry. So I'm completely, with you on the ethical part. I think even from a business standpoint, that is a smarter strategy, and we have seen that in the Amazon model, and we have seen that in the Costco model. If you want, the regulatory scrutiny is something which may not happen, will take time, you can sneak around it, all of that. But I think if you really want a robust business model, and especially in this sector for the long period of time, you know nothing beats that. If you can improve efficiency and if you keep your costs down, people get a sense of it, right? Even when people are going to a hospital A versus hospital B, and it is such a high purchase item, people will get a sense, right? This guy charges 70,000, this guy charges 40, 50, 60,000. Maybe the outcome is same, or even it is better over here. People know that, and that word of mouth spreads. So I, even from a pure financial standpoint, forget the ethics part of it, I would always prefer a hospital chain which makes maybe couple of percentage points lower than, lower on ROC and RPOB and all of that, than compared to a chain which says we increase our RPOB by 10% and our ROCE went up by 30%. I think that's a more risky business model than the second one. Even, I mean, as a short-term investor, will say, let the stock go up, boom, and I will make money and I will exit out of it, which is fine. That's not a moral or an ethical argument, right? People do invest in cigarette companies also, right? So I mean, we should not pass judgment on that. But if you want to buy and hold, or you want to be a long term investor, then I would prefer the second model, because that has more sustainability, everything else being equal.
Can I pitch in this for a moment on this
Yeah, yeah,
specific? I track the hospital sector very closely, being a
sure.
ex hospital management professional. Now here, Rohit, the question which you sort of discussed earlier, the TAM thing comes into play very much.
Yeah,
If you see that the oncology TAM is actually increasing day by day.
that's true.
Meanwhile, the pediatrics TAM is decreasing day by day thanks
Right,
to the immunization, child health, and
right,
low mortality at the birth rate, at the
right,
birth time.
right.
So if you see that a lot of, because hospital is one of the oldest industries when it was not even considered an industry.
Correct.
If you see the emergence of the children hospitals have been specifically positioned children hospitals have been much less than the other specialties or super specialties, which included oncology. Oncology was
Correct.
set up because the entry barriers to oncology units were very high in terms of capital,
Correct.
as you said, because of the high, of course, they give high ROCE, but the entry barrier to oncology is very high. So,
Correct.
in those terms, see, if you see way back 20 years back, pediatrics as a branch of medicine was a very flourishing branch.
Right.
Nowadays, it is much, much, much lower in the even the doctors who are attempting to do a PG. It is much, much lower in the preference.
Okay. Okay.
Right. The reason being is that you put up a clinic of yours and you hardly break even because the
Okay.
maximum a child suffers is fever and sort of these things. Beyond that, till 12 years of age, this population is actually prone not to have too much of problems
Correct.
as far as the health is concerned.
Correct. Correct.
So it
Correct.
is it is both the way, it cuts both the ways. So as
Correct.
a investment proposition, one has to weigh in whether the children's speciality as far as the hospitals is concerned, or the oncology, what is better of the two in terms of the
Right.
future valuations, etc.
Right.
Number two, there is a specific disadvantage in specific positioning of a children's hospital because the infrastructure which is being utilized and the specialties which you have to keep is almost as good as an adult hospital.
Correct.
So, by just narrowing down your total addressable market to the children's only is actually underutilization and is subject to fluctuations of usage in the long term.
Right.
So these
I,
are the few elements one can have in the
correct.
perspective
I,
because the thing was going on. That is why I interjected.
no, 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 those are very, very good points. I think I'll just add one more to it. I think at a broader level, we are a very underserved healthcare market. So I think
Yeah,
that said, I think the it's a
I
the overall space is pretty big, no matter whatever sector, whatever sub segment you consider. So maybe that's
yeah,
point number
exactly,
one. And
exactly.
second, I think it's not just unaddressability or whatever unmet need. I think one aspect which you can see from a global perspective is that as income levels rise, right, the spend which you have on healthcare increases, and in addition to your own spend, think of what you do for your kids, right? As your spending,
Yeah,
as your income level increases, if you are, अगर आपके बच्चे को थोड़ा सा भी अगर दो छींक
I
भी
agree.
आएगी, अब when we were small, what would our parents say? ये लो अदरक की चाय पी लो and then you're done,
Yeah,
right?
yeah. No, no, I
अभी
agree
what do
with that.
parents
See, every
will
argument.
run to hospital?
No, that is where I thought I will just put in this thing. See, because
हाँ, correct,
see,
correct,
one more thing is there. See, in Indian scenario, and that is for the next 10, 20 years as well, which will be well established, the economic value of an adult life is much more than the economic value of a neonatal life.
correct, correct,
So
correct,
that also plays, but that plays in a market which is addressing only the lower segment of the income group.
correct,
Right? So the
right,
expandability of that pediatrics into that market
right, right.
segment is normally,
It's
these
not
are the
there.
headwinds which are there.
Correct. Maybe there'll be just super specialization where
Yeah,
you will have a limited set of chains who just specialize on the pediatrics. Your smaller practices
yeah,
will go away. Again, I don't know, speculating.
yeah,
We'll have more verticalization which will happen, right? Where these become your centralized, hub and spoke model, right? Where you have smaller clinics for most of the stuff. Like if you look at it globally, that is what is also happening. You have a lot of these walk-in clinics and a lot of walk-in clinics for children also, and then you have these centralized big hospitals which take care of all the complex cases. So you do not want to distribute capacity with 20 small hospitals or whatever, 100 small hospitals. You have these walk-in doctors, clinics, whatever, with limited this thing, and then you have the central bigger hospital which will take care of all, maybe whether it's adults, whether it is children, at the centralized place. So anyway, yeah, it's a no, those are very good points.
Just to add over here, like just in terms of the children care hospital, like out of the 5,000 bed industry, one particular player already I think is like operating 15 to 1600 beds, And also the
Right.
incremental 1,500 beds or 2,000 beds which are being added in the industry, out of those incremental beds as well, this particular player is adding 800 beds. So maybe it might be like that, because the size of opportunity might be less. So few large players, they keep growing, and like
Correct, correct, correct.
multi-speciality clear, there's no incentive to enter at the moment, basically.
Correct. And that is happening across industries, right? We are seeing consolidations, scale, especially in a country like India, right? We are seeing this aggregation. I think I was reading somewhere, I don't remember which article or which video, that across industries we are seeing a few trends which are happening, right? And this is again the same unorganized to organized sector, or whichever way you want to call it. Aggregation of capacities and consolidation, right? It's happening in retail. We are, obviously it will happen in healthcare, because that's where the efficiencies will come in from, right? So I'm sure, right, this is part of that larger trend. And then with technology, that centralization can get turbocharged, right? Because digitally you can reach people, telemedicine, open a small satellite location, and then that all feeds into the central location. So I'm sure we'll see that trend. Right.
Uh, right.
Go ahead.
So next is Pranjal. Pranjal, you can unmute and ask your question, please.
Hello, Rohit sir.
Hello.
Hi, Prince. Like, first of all, I just wanted to say, like, thank you for giving this opportunity to, ask my question. For someone who's like trying to break into equity research field, like this, like listening to you has been really insightful. So my question was on the concept of operating leverage and the J-curve phenomena. So as we see, there has been a strong push in capex in the chemical sector,
Right.
which from the looks of it is actually experiencing long-term tailwinds.
Right.
So in some cases, like the gross block for these companies is going to double or even triple in some cases from
Right.
existing levels.
Right.
So the dilemma I had was in relation to the supply side dynamics of it. We know there
Right.
will be a big bump in sales for these companies in 3 to 5 years.
Right.
So do you think there can be a situation of oversupply in the sector?
Okay.
So like
Yeah.
wherein like even if these companies like grow their top line, there might be a probabilistic scenario
Yep.
where the
Yep.
quality of these earnings are affected. Uh,
Absolutely. Yep.
and secondly, the second part of it is like, or like this will not happen because most of these companies are actually spending this new capex money on higher margin niche businesses, and they're sort of moving up the supply chain, value
Right.
added products. So how do you like just think at like look at this from a risk reward scenario, like again
Right.
from a 3 to 5 year point of view?
Right. So no, I think you brought up a very good. I was anyway planning to cover this. I'm just looking for the name of the book which I read. This was a very, I think the name is Capital Returns. So and I think I spoke about it in I think maybe one of the podcasts or spaces earlier. So I would highly recommend reading this book. If there's one book which you should read from a fundamental standpoint, I would say, you read this particular book called as, I think it's called Capital Returns or Capital
Yeah,
Returns
yeah,
and
sure, sir.
Capital.
Like I actually like, yeah, I know about that book, sir.
So you should read that. So let's talk about this, right? And there's a reason why I brought this book up, because this book talks about, and if you are going to invest in cyclical or even in non-cyclical industries, I think this is an exceptionally good book to think through, how cycles work, right? And we'll compare and contrast chemicals with the oil and gas sector, right? uh, the oil and gas sector has gone through a 7 or 8 year period where it went through the upcycle peaking in 2014, and from 2014 to 22, capital has just gone out, very normal capital cycle where capital went out. Now capital is not coming into the oil and gas sector because of non-economic reasons, right? So which means, obviously, supply is not coming in. That's the flip side of what we are seeing in the chemical industry, right? uh, if you read through that book, it talks, example after example, that as the industry starts growing, as it becomes, like a uh, uh, I mean, as companies and management start looking at the entire sector and they see this demand going up and up, a lot of capital moves in, right? And standard capital cycle is what? capital moves in, capex starts going up, and invariably as capital goes up at a certain point of time, you have oversupply and the returns fall down. So I personally think that's definitely a big risk in the chemical sector. That when you look at the numbers which are being thrown about, right? You have companies like SRF and all the other companies talking of big capexes, right? And again, these are whatever we are seeing in terms of demand for the specialty chemicals. It's not just Indian companies looking at it, right? I mean, I have not dug deep into it, but globally also other companies can also look at it, right? And the returns are very high. So there is definitely a risk. I definitely think there is a risk that as this, and that's what I've been thinking for about some time, that with all this capital coming in, what is the oversupply risk, right, at that point of time? Because once all these capacities come online, even if there's a slight blip in terms of the demand, it could, again, it could be a little bit more nuanced, but I think this whole discussion around EVs and all of that. So let's take that same space, right? One of the trends which we are seeing in the chemical space is that with all these EVs which are coming up, and there will be a lot of demand and all of that, and that will drive the demand, right? And that will divide the pricing. But I think what may be getting missed is this. uh, as a whole, humanity and people are very smart in terms of figuring out how to do substitution. So if you follow the EV space, you would have heard about cobalt being one of those high priced uh, inputs which go into making a battery. And the people were talking of, we are short on cobalt, and this will happen and that will happen, and a lot of capex came in, right? And now if you look at cobalt pricing, it's actually gone down. So everybody thought cobalt comes only from very few limited spaces, requires technology, etc., 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 and then it will it could challenge your production. And lo and behold, capacity came in, and that's it. Cobalt prices are down. Same thing for lithium also. People keep saying lithium could be this and that, but when there is enough demand, and when there is enough money to be made, competition comes in and drives the capital down. So I definitely think that risk is there, that as capex comes up, there could be pressure on the pricing. And then the second aspect which I think is worth thinking about, and the topic of this talk is diverse approaches. Look at all the stocks in this space, and if you do stage analysis and all that, if you look at it from a technical standpoint, everything has flatlined, right? Almost the entire sector is kind of, if you look at that, that whole stages, right? 1 2 3 and 4, it's kind of in stage 3 and stage 4, most of the companies. So either the market is saying, I will wait and watch and see how all of this plays out, or the market is not convinced, right? So now you have to think about, is this a temporary lull before the capex comes in and the pricing picks up, or this could be the start of a new capital cycle? So tough to say, but I am a little bit 50-50, maybe 55-45 on the capex cycle, because that is what, when I saw these charts, that when I saw everybody going gung ho, I started getting worried that so much capital is coming in. Now what, right?
Yeah.
So
So like just like a small follow up on that. So so when you look at this industry, so would you say like it would be a better play from a risk, again from a risk reward perspective, to sort of play the more consolidated industries? So like in the way, like there are only like 3-4 major players, and they have all the market share and all the technology.
right.
So because I'm saying this because you mentioned SRF, so have been studying a little bit of the fluorine space and seems really exciting. But again, I wanted to understand, like, would it be a better play?
You're saying in terms of so again, I know my own understanding of the fluorine industry may not be as good as some of the folks on this call itself, right? So I'm taking a little bit of an outsider's view. uh, I know there is a lot of, see, the demand is a given, right? The demand is coming in, there is requirement and all that. My concern is that in in case that if you are going to play the industry, first of all, it's a little bit of a wait and watch. But if you are going to play the industry, you're right in the terms of a consolidated player, the advantage will be that at least you will have the benefit of low cost of operations, right? Like if pricing does not really, if pricing is not really that great, at least the low cost player will be able to survive. And again, I think you have to blend that with the valuations also. Like some of these companies, the valuation assumes the capex. So that's the other element to this, right? uh, the assumption is that these companies will not only put up capex, the pricing will remain good, and the return on capital will also remain good. That is being kind of being priced into the current prices, right? If something is selling at 50-60 times earnings, it better deliver on its numbers, right? Versus if something is selling 25-30 times, then that's okay. There is a margin of safety, if you may. So I think it will be a little more nuanced, that in the sense, if you can look at the valuations, and if the valuations are reasonable and there's a margin of safety in, assume that the current margins may not sustain when and then just try to model and see, if it goes to a slightly lower margin, will the company do well? And then obviously you'll have to be patient. If you think the capex comes and the market price may suddenly swing up, maybe that will not happen.
Sure, sir. And Ishmohit, I know you've also been studying this space, so I just wanted to understand your perspective, if possible, like if I'm allowed to ask this question. So your perspective on the whole dynamics of the sector right now.
So am I audible? Rohit, so should I take this question or?
Yeah, go ahead. Yep.
See, I think it's like what bottoms up, like because where we are in the cycle at the moment. So not like last 1 or 2 years, any chemical company you picked was doing well. Right now, it has become very bottoms up driven. So specifically the space you spoke about, fluorination. Oh, over there we have seen like there are like 3 companies and even more companies are trying to enter that space as well. But you can break that space, and if you just go back to the history, you'll see that before 2010 you won't hear name of these any companies. I think Rohit sir has been in the market since 2000. Sir, SRF, Naveen or Gujarat Fluorochemicals ka example, like did you like hear about these companies at those times between 2000 to 2010?
No, none of them. SRF maybe, but yeah, Naveen Fluorine and Gujarat Fluorochemicals definitely not. They were not
So
in the
one of the things
chemicals.
that
Yeah, chemicals was actually a no go space. You have to remember that till 20, like again, just as an example only, Vinati Organics, when I invested in maybe 2010, there was no story around chemical and all that, right? Chemical was, people used to talk of chemical in the same breath like you would talk about sugar and steel, maybe even worse than steel. Chemical was not a space anybody looked at. So times change, right? It's not the and rightfully so, right? There is knowledge and technology which has come in. It was mostly bulk chemicals since then. Anyway, go ahead, Ishmael.
So I think one of the things that happened specifically to this fluorination sector was that fluorospar mines in China got exhausted because China didn't have the largest reserves of fluorospar. So also they had to venture out. And secondly, carbon credits were given to these companies because these companies were basically rev gas manufacturers. So they were making R22 and R125, जो भी एक bulk rev gas है, which is going to start being phased out from next year. So these companies were given carbon credits of 500 crores, 700 crores, 600 crores, and all these companies this basically started shifting their focus from bulk chemicals or bulk ref gases to R&D oriented approach. 2011, Naveen Organic, Naveen acquired Manchester Organics. 2008, Gujarat Fluorochemicals set up the first plant for PTFE. 2013, first site of SRF, where actually that international fluorine symposium is also held. Like all fluorine companies come to that site. So that first site of 250 to 300 acres was set up using the carbon credit money. So this is how the dynamics of the sector changed in 20 post 2008. So what has happened since then is that fluorination usage has expanded across a lot of new molecules which are coming in. Like to agro may, like out of every 2 molecules which are discovered today, one is manufactured using fluorine. Even within pharma, out of every 3 molecules, one is manufactured using fluorine. Similarly, in fluoropolymers as well, your new use cases arise. पहले तो सिर्फ आपका वो टेफ्लॉन वाला use case होता था. Then it started being used for manufacturing of semiconductors. EV के अंदर as a separator use होने लग गया PVDF. So what has happened? The use cases have really exploded, but few companies within the Indian context have that really have the supply side advantage of sourcing fluorospar or working with fluorine. Like talking to some of the people in the industry, why is it very very hazardous? हर एक shop floor पे there is an antidote injection which is basically kept, because if anyone comes in contact with fluorine directly, if he doesn't take the antidote, so within 4 or 5 hours, like it will basically lead to a fatal outcome. So also like experience of handling fluorination is really really difficult. But that being said कि three companies हैं, oligopolistic setup है, near term में there could be some issues, like जो rev gases का भी phase out हो रहा है, तो we don't know कि how much the जो pricing of जो rev gas है that falls. So over earning wala element, especially like especially with SRF's example. So how much they are over earning on the margins, that is something we have to think about, because I think 50% of their chemical business is rev gases. So that is one area where you have to be a bit careful. And also in fluoropolymers, like if you talk about like Gujarat fluoropolymers, then you will basically uh, then over there basically you will find that in that sector, like it's again an oligopolistic play. Like very few companies are in that sector, and 3M is actually quitting that fluoropolymer sector at the moment because of like PFAS issues. So how they are themselves are able to deal with this PFAS issue, so that is something to be seen. But they claim that they've developed the PFAS free technology. And secondly, ye now ki because the markets are growing so fast that 3-4 years down the line, something like Borosil renewable ends up happening. That 3-4 years down the line, Chinese players also see that this market has become very large for me, and then they start putting up huge capacities, and then dumping starts, like what has happened with Borosil, like this solar glass manufacturer, because वहाँ पे it was just a shallow mode based on anti-dumping duty, right? Once it was lifted, and again problems started. So
the
these issues you'll have to deal with basically in the near term, like अगर इस sector की आप ज़्यादा सोच रहे हो तो.
I think it's a you can always use a simple thumb rule that if it's like a literally almost like a iron law of economics, right? That when the returns are high, you will get competition. Now you have to start from that baseline and see what can prevent these. So that's where I think maybe you can the aspects which you have been talking about. Time horizon in this case, there is no easy and quick money which you may make. And second is, if you are a 3 to 5 year kind of a investor in these companies, you will have to think about these competitive dynamics big time. Start with an assumption that with all these high returns, everybody can see this demand is coming, right? This is not secret only for some companies in India or in some places. Everybody can see this is coming. Is there a major technology barrier, or is there a like if there was an IP barrier, right? Like like we see it in the pharma space, right? It's a new chemical, new drug, requires a lot of research, etc., etc., a lot of time. Then that's a big barrier. In this case, is there that barrier? I mean, I don't know enough. Maybe Shmoit knows it. Is there a barrier enough? You have to think about that. If there is no barrier, then are these companies just 3 to 4 years ahead of the cycle, or are they, or will the new capex take much longer? I think those things you'll have to think of. Uh, if they're
Sure.
just 2 3 years ahead, then that's a risk which you may end up facing, right? Other companies, other countries, they will definitely jump in, right? If there's so much. And by the way, you have to keep in mind the the whole concept of depending on outsiders is going down. So if US wants to develop its EV industry, which is obviously does, it is already starting to, and it will insist on some of these backward integrations to move into the country. Same way for Europe, same way for other countries. So you have to think of that, right? That are these technologies, can they be developed by these other countries also? So anyway,
Sure,
I
sir.
don't.
Yeah, that the reason I asked was like because I mean I had studied the pharma, and I mean I totally understand that it's an NC and like they have the patent and it's not an ANDA. So the only reason I asked is like because I was not able to figure out like like what is the edge, like how will they be able to deliver it. So yeah, this was like really insightful. Thank you, sir. Thank you, Ishmael, and thank you, Prince, for giving me
for
this
giving me this
opportunity.
opportunity.
Thank you, Pranjal, for the
One thing to
One
conversation.
thing
add
to
on that point, is that like specifically in that like like one of the agrochemical giants within the fluorine space. So they will do capex even in a down cycle that we have seen between 2015 to 18. When there was an agrochemical down cycle, they went and did a 2 to 3 thousand crore capex, because that is how like aggression of the management is. So over there, you just basically, if you just study the last 15 years of cycle, it will give you so much insights into this industry. And also with this fluoropolymer thing, I think just to answer Rohit sir's question, there is a cycle of getting these products approved of 2.5 to 3 years. So during those, it's a very painful period, because once your capex goes live, then there is a cycle of getting it approved, getting all the grades approved. So there is a very good mental model that you can use. Anything that can be manufactured at scale will eventually be commoditized. चाहे वो कोई फार्मा का प्रोडक्ट हो, चाहे वो कोई केमिकल का प्रोडक्ट हो. But the second model to think about is anything which requires multiple SKUs to be kept, or is manufactured in batches, or is smaller in size. That is where your difficulties of getting into the industry starts. And that is precisely the reason why even in last 20 to 25 years, no Chinese player has basically tried to get into the new age fluoropolymer or the niche fluoropolymer products. So that is one of the like clues where you can go and basically pure industry जाके you can study. So
Correct.
that is it from my
So,
side.
so think of it like your software as a service sector, SaaS sector. Anybody can write the code, but selling, the bottleneck is not manufacturing, right, or not developing the tool, right? I think you can cut your, you can jump across industries and use the same thought process, whether you talk of the chemical industry, whether you talk of, say, let's say, and I know, Shmut, you have covered this in some of your videos, companies like, RHI Magnesita, which makes all these alloys, or companies like AIA Engineering. The challenge is not in just manufacturing alone. A lot of companies can just manufacture, they can get to a scale. The bigger bottleneck, or the tough problem to solve in these B2B business is reaching out to customers, forming a long-term relationship with them. And mind you, in all these spaces, whether it is the SaaS sector, whether it is these mining sector, or whether it is chemical, the the buyer is not buying this in bulk. The product is not entirely fungible, right? It's not like I buy from company A versus company B. No, buying from company A does matter for various reasons: service levels, quality of product, consistency, reliability, etc., etc. And once that relationship is formed, there is an economic value to it. So if you want to study some of these industries, think of the front end of the value chain, as to how many companies, sectors do they address, and what is their relationship. Because if they have these strong customer relationships, today it is chemical A in the fluorine space, tomorrow it could be chemical B, next it could be chemical C. They'll just hop on from one product to the other product. Their competitive advantage comes from having this, having controlling this value chain and this pipe to the customer. So I think then the whole capex cycle becomes less critical. But you have to be patient over here, right? Yeah, this is one case where you will use less technical analysis and more understanding the industry in depth, because this is not a 1 year idea of any sort, right?
Just look at
Sure,
this
sir.
example of like the new age rev gas, that is HFO, which is being manufactured outside of like the like North America region, and like one facility which is there in Europe. Second facility for toll manufacturing is set up in Gujarat, and
Right.
that is a molecule which itself is growing at 25% CAGR.
Correct.
So that makes it very very interesting, because he's in like that company is in a toll manufacturing business with the other company, and like
Correct.
they're already talking about doubling the capacity, because molecule itself is growing at 25% CAGR.
Correct.
So
Correct.
again, that is a contracted business. जितना contracted capex है उतना better है, because जितना like once you do the capex and you have to sell on spot, that is where like a lot of uncertainty comes in. All the pain of
Right. Right.
capex, of like
Yep.
deleverage, everything hits in. Like even in this coffee business, which is the coffee processor, they'll put up capex when 50% of the incremental capacity is already booked out. So they have already announced the
Correct.
leg of capex is the 50% of incremental capacities are already booked out. So inherently, I think these are like superior business models to basically
Yeah.
study. अब वो स्टॉक अच्छा है नहीं है, है नहीं या नहीं है, तो दैट इज समथिंग दैट यू हैव टू थिंक अबाउट वाइल वैल्यूएशंस. But inherently, I just think these are superior business models.
So if you zoom out, the business model is basically these companies are an extension of the customer's own capacity, if you may. If you start thinking of all of that, they are embedded into the any product which is embedded into a company's production. Embedded as in, like, obviously everything goes into a production, but how fungible it is, right? Or how easily the whole concept, the standard five, the 5 factor model from Porter, right? How easy it is to switch suppliers. In all these cases, switching of suppliers is tough. So I think if you just use that as the the guiding factor, if I were to switch a supplier, how easy would it be? The moment you try use that particular mental model, it will start answering a lot of these questions, right? And obviously that goes for individual consumers also, right? If I like a particular product from a particular company, I don't want to quote unquote switch my supplier, right? It goes from a hospital standpoint also. If I if I prefer a doctor and if I prefer a hospital, and my the branding is strong and I like that hospital, I will not switch supplier based on cost. So I think that's the key way you can just cut across industries and think about it.
Sure, sir.
Sure, sir.
Thank you, thank
Thank
you.
you. Thank you.
Really
Really
insightful.
insightful.
Thank you,
Thank
Prince.
you,
So
Prince.
Rohit sir, I just wanted to check like how good we are on time. Actually, I mean we are already 2.5 hour plus, so it's totally
Right.
up to you. I'm
What we
fine.
can do is I'll quickly cover one last topic.
Right,
And
right, sir. And then we take one question from Arun and one question from me before we close.
correct. So I'll just cover one last topic, then we can have two questions. And I know it's Saturday evening, and um, I'm surprised myself to see so many people still tuned in and listening in, and they have not zoned out. So that's interesting. So let's come back to the original topic of I know we went we've covered a lot of diverse points on this, but I think the focus was how do you combine all these diverse approaches for optimal results, right? So we spoke very quickly about technicals, momentum, quant, and everything. So let's try to break it down into how you can develop a framework. Or let me share a framework, which, again, keep in mind that I have been thinking through this is something which I'm just figuring it out for myself, right? There are no standard formulas, there is no standard template you can do it, right? Each one of us will use it to figure it out for themselves. So the way I think about it is this way. I look when I'm looking at my portfolio, there are companies which I'm thinking, when I look at a particular company, right, I'm thinking, is this a cyclical slash a quick play which I'm looking at, which means it's like a 6 to 9 months kind of a window, or a 12 to 14 months, or a 2 year kind of a window? Maybe let's bring in a little more technical angle into it. Look at the technicals, do some kind of stage analysis, think about it in that fashion. Because a company which is more cyclical, which can violently go up and down, there is value in understanding the stage analysis and knowing where you are standing in the cycle. So maybe you use a certain percentage. I'll just throw some numbers out. There's nothing particular about these numbers, but let's say you will use 60% fundamentals, 40% technicals. What does that mean? Like, let's say you're looking at a company for your satellite portfolio, for a short term portfolio. You will give enough weightage to the technical factors. You will say, what, if it is in a stage 3, stage 4, or stage 1, I will wait for the technicals to improve. Even if the fundamentals are good, I will not buy into it, and I will wait for it, and I will only buy at the point of inflection, and I will ride that particular stage too. So when you are so you brought an element of time, you brought an element of cyclicality into the company, and you brought an element of the tools, right? So short term means you look at the momentum aspect to it. Am I early in the momentum, and am I late in the momentum? If you're late in the momentum, your expected time horizon will go down even further. Let's say a company has been in momentum for 3 months. Usually the company will go out of momentum in the next 6 to 9 months. So that is your window of operation. Doesn't matter what the fundamentals are, doesn't matter what the other things are, right? So that's how you will start thinking from a selection standpoint. So uh, put all these variables or all these factors into a simple a checklist which says, if I'm looking at a particular company, what type of industry is it? Do I look, if I'm looking at a cyclical industry, and I think it's very cyclical, like a steel or something, or oil and gas or something of that sort. And if the time horizon I want to approach it from is a shorter one, let me start looking at technicals and things of that sort, right? So list those factors, which stage it is at, what what's the earnings trajectory, right? Is it growing at 20% plus in the near term, and will it continue to grow at that particular pace in the next couple of years? Because that's what you care about. You don't care about what will happen 5 years from now. And don't get too focused on valuation, right? Because valuations in a 2 to 3 year time period do not matter as much. Like one of the questions was 50 PE, right? A 50 PE stock, it's not a big deal if you're going to buy it based on business momentum slash technicals for a 1 to 2 year or max to 2.5 year period, right? So that's one aspect to it. But let's say you look at a company for, you talk about the quote unquote compounder kind of a thing, right? Where you're looking at, let's say, the chemical sector, or the healthcare sector, or some of these slower growth but kind of longer term ideas. Don't worry too much about the technical, right? You just want to ensure that you are not in some sort of a long term, like a real estate sector which has a very long cycle, right? A real estate sector has almost 7 to 8 years of a cycle. So you don't want to be like 2 years 3 years into the cycle, the stock is kind of just languishing, and you buy and then you sit on it, right? So outside of that, maybe a technical is just a very quick initial filter which tells you, okay, where is that particular stock sitting, and how much time do you have to kind of just think through it, right? And then dive far deeper into the fundamentals part of it. Also be focused on the valuations bit of it. Where exactly is does the company sit on valuations? Is it way above its mean? Is it way below the mean? How are the margins looking like? Typically, if you are not looking at a company which is in a major run up phase, the margins will be in and around the mean, the valuations will be in and around the mean, right? As long as that is the case, reasonable valuations, reasonable middle of the cycle margins, dig deeper into the company, right? Spend 70% of your time, or 80% or 90% of your time on the fundamentals, and think of it from a 3 to 5 year kind of a time horizon. Now, there is a concept called as factors in investing, and I think there is a book called as Factor Investing, which I would encourage all of you to look at. But typically, what that says is that investment returns or excess investment returns are driven by some 5 or 6 factors. The first factor is value, which we all know, right? Value mean being cheap, right? Buying something cheap over the long run, it works out better. Second is quality. We all know that, right? Third is momentum. We just spoke about it, right? And then there are few more smaller factors called as duration and carry and all of that. We'll ignore that for now. So the idea behind all of these diverse approaches is that when you think of your portfolio and your diversification, you think in terms of position size, you think in terms of industries, also think in terms of factors, right? Also think about time horizons as to how you can make a blend of different time horizons in your portfolio. Some positions will act like a ballast, right? They will provide you steady lower stress returns, not necessarily lower risk returns, but at least low stress returns. And some will give the sizzle in your portfolio, right? The extra alpha, right? Where you get yourself entertained also, and you do all kinds of active stuff, and that you can call it as your satellite portfolio, and then you use these different tools into each one of these, right? So think of it in that fashion. And what I have done in the last few years is break down my, anytime I'm looking at an idea, to whatever route it is coming, I'll start thinking on these variables, like, you know what is the duration I want to look at this particular company for, like what tools should I pull out from my toolkit and start applying on it, right? It's a short term cyclical one, okay, so start thinking more technical, start thinking momentum. It's a chemical industry, long term, hospital, much long term, financials, a little on the longer term side, but with cyclicality in between, right? Think fundamentals, think sector analysis, think competitive advantage, things of that sort. And then start sizing based on that, right? A long term steady position can have a larger sizing. A shorter term riskier cyclical position which you'll have to jump in and out, will have to be a smaller position, right? You can get a big 10x, but you don't want to make it very big, right? So that's from a portfolio construction standpoint. So anyway, I think that's at a very high level. Maybe one of these days I'll post a kind of an article or I've been lazy around that, but I'll post a blog post around it, and maybe a picture or something, based on what notes I've made. But this is something I've been thinking for the last 2 to 3 years, and I think there is value in terms of just exploring and building a framework around it. So I'll stop here, Prince. Any
Any
questions on
questions
this?
on this? Right, right, sir. So, you can quickly unmute and ask your question, and then I go for it.
Yes. Hi, can you hear me?
Yeah, go ahead.
Yeah, thank you, Prince, for the opportunity. Very quick question, sir. Related to the ER&D space in the IT. So I just wanted to understand your view, since we have like only a handful of listed players, and some of them have like really gone up in the last couple of years, but now things are cooling down again. So do you think that any of the companies, let's say, have some right to win, although we have like some very focused vertical companies and some like more generic in that sense? And how do they compare with the, let's say, the vanilla IT services companies in India? Thank you very much.
I mean, I've not really dug too deep into the ER&D space. I do think, I mean, uh, based on my background in the past and everything, I do think they do have a right to win and all that, and they will do well in the long run. But like we've been speaking so much about, right? All these things have their cycles, right? And there was a time, like the Tata Elxsi example also, which Ishmoit was talking about. It languished for some time, and then it just, with the whole COVID wave, anything technology, anything IT kind of got their that wind in the back, valuations went up and everything, and now that valuation is mean reverting, right? So in the IT space, at least my personal view is, this is no longer in that hockey stick phase, right? Where you have some of these new age models both in India as well as abroad, which are coming up, right? So the likes of software services which are coming up in India, they are still in the J curve phase, right? Where suddenly they are accelerating and valuations are less important, right? And the more important piece is, what is the size of that opportunity, and can that company capitalize? These are mature business models, mature companies. They will definitely grow at a high enough pace with a tailwind. But I would personally would prefer to look at them when when boredom sets in, right? Which in technical analysis terms means stage 1, where that boredom steps in and people kind of start losing interest, and the valuations, most importantly, start coming to a more. So this is where you have to, when you look at these companies, you should not look at an absolute valuation level. Look at that company as a thumb rule. At least look at the average or the mean valuation for that particular company. So if a company like a Tata Elxsi, and I don't have the numbers in front of me, on average has sold, let's say, just to take a number, 25 times earnings, then get a little more, start looking at it a little more, with more energy. Do your homework now, but look at it more actively as it gets to that. Because just like earnings, valuations and market psychologies also go through these cycles, right? You can pull up any chart and you will see that valuations go from undervalued around that median line, right? And I think Screener has that, right? Undervalued line, then the valuation line will keep going up, and then it will peak at a certain time, and then it starts going down, right? So valuations have their own cycle also. So the moment that line starts crossing and coming near the median, right, start getting more interested, because these companies are not going to go into that exponential phase, right? Think of the business model, right? You're going to a end customer, they are outsourcing some of their internal processes. They're not going to just suddenly drop everything and just hand over everything to you. It's a gradual organic phase. These companies will keep getting embedded, right? Now whether it's the ER&D space or whether it's the pure vanilla, this thing, slight nuances in the business model, and growth rates are obviously higher in the ER&D space, but broadly, I think the trajectory will be fairly similar. It is slightly more on the mature side. These are not really very high growth businesses.
Sir, a quick follow-up. Thank you. So, for example, I mean, just with this Tata Elxsi and KPIT and these like really shoot up on the back of this EV boom and stuff. But now, I read like on Twitter and some other places that now most of the automobile companies are trying to have an in-house expertise
Correct.
where they want to build like all these things in-house. So do you
It
think
will be a
like that
blend
will
of it.
still be a factor taking like in their future or something like that, or
It will be a
will it
blend,
impact?
like in your typical IT services, right? It's always a mix and match. Companies will have some expertise in house, they will supplement it. See, the trend around outsourcing, which started way back, it's not going anywhere, right? Companies think of it like this way, right? Companies will have a certain baseline capacity. Forget the narrative and all that. Long term, I think it's a given that every company will balance both outsourcing and in house. They will have a certain, think of it like they will have a certain baseline capacity of internal resources with that expertise in house, and then they will keep this spare capacity outside, right? So that every day, because auto and all these are very cyclical industries. Even see, even a lot of this EV related stuff, there's a migration which is happening, but the total number of cars which are being sold is not going up. I mean, different losers and winners and all of that will definitely happen, but still there is cyclicality also in that. But that being said, all these companies which are and R&D space is much larger than that. All these companies will definitely keep certain baseline capacity internally, and they will outsource the rest, and the narratives will just play around that, right? When the industry is in a boom phase, valuations are going up, everybody will look at only the positive side of it, say, oh, everything is moving to offshore and everything is kind of getting outsourced. And when the reverse happens, people will say, oh, the news items will say the companies are wanting to take it in house. But the reality is it's a balance. Any company will keep a certain percentage in house, certain percentage out, and they will optimize around cost and around service levels and around capacity. So that broad trend is not going to change, and that's why working around the averages for this sector actually definitely makes sense. Versus something which is in a J curve, don't go by averages. Their averages don't mean as much. If you are in a high growth SaaS kind of a sector, then you need to see the trajectory and not the average.
Sir, just finishing with with one last thing on this. So as we know, like these ER&D companies, they need to hire, let's say, a lot more bench strength, and it's more capital intensive than the regular service industry. So do you think like company like, for example, it's HCL Tech, which has this now a good ER&D division, will they pose any kind of a competition or a threat to like more niche players like LTTS or Tatilexi or things like that? Because they have
uh,
like more cash, so they can
it, no,
yeah.
cash nahi, I think it's just a matter of a different mindset. If a company like a HCL Tech or an Infosys, they can just bring that. See, the difference between the IT services and the regular businesses, that the management should not spin out, but should put that in a separate division which is run by different metrics. Because what happens in traditional IT services is the focus is on utilization, churning. Take a person from, again, I'm just making this up, but I have been from that industry, so not too far. Take a Java developer and ask him to go and do programming in C+. I know I'm just making an extreme example. That's not true, but that's how companies often behave, right? Pick one from some place and put that. So the idea is, high I know this is, we are talking of people, but that's how it is, right? High asset turns, commoditized business model. Versus ENR&D, it's a more specialized business model with less asset turns, right? So as long as the big boys can put it in a different division and have it run by their own metrics and not try to superimpose the more commodity model, I'm sure, obviously, there is nothing very unique. See, you have to keep in mind, there is no exceptional IP to build these practices, right? Any of these big guys can actually set up a division. They already have the customer relationships. What stops them from hiring and slowly developing a practice? It will not happen in 6 months, but they can always say, I will develop an ER&D practice in this particular vertical over the next 3 years, and they can invest some money, and they have the relationship, and they can slowly put 2 people and then 5 people and then 10 people and 20 people. So they can do it, and maybe most of them will slowly do it because it's a higher margin business, right? Same 101 of competition. Why will they not do it, right? And I'm sure they must be thinking about it, right? So yeah, that competition will, I think it will come up for sure if it becomes a large enough space. Or if it is, I mean, it is already a large enough space, so it will definitely come up.
Thank you, sir. Thank you.
Thank you, Arun, for your question. So Rohit sir, like the last question is like we had budget last month, and the result also for the companies came out, and as we spoke a quarter away, although not much changes within one quarter, but again, how you see the budget announcement and the recent results, China opening up, you already touched upon. So broadly, like how in the broad sense, if we look at the market, so what's your view, and any interesting investable pockets you are monitoring closely, if you are comfortable telling?
Yeah, so let me first give a caveat. Obviously, we cannot give recommendations and everything, right? Definitely not individual names. Second qualifier is that I usually don't look at the budget very closely. If I see some news and this and that, but I usually have, in my entire investing career, I've usually not bothered about the budget. One thing which definitely stood out for me in terms of a trend is that the government continues to focus on the infrastructure space. Again, focus and talk has always been there. The implementation has been lacking, but when you look at the micro level, the implementation is also happening, right? The entire, whatever investments are happening in the water sector, in the in the electrification, in all of that particular area. So that is definitely, that is definitely a positive, and it all has a multiplier effect, and we are already seeing that, right, with all the capital good. And if it's not just, by the way, it's not just India alone. Keep this in mind. Electrification is happening across the globe, obviously, right? We all know. The interesting thing which I've read and I'm seeing is that in countries like the US and Europe, they are trying to rapidly electrify and upgrade their grids, and they are like short of electricians and all that. So which tells you that the trendline demand has gone up. I mean, these are temporary shortages. People will get trained, and the capex build will happen. So a lot of that capex build is not only in India, but it is happening across the globe. And some of it is obviously the whole, reconfiguration of the global economy. Manufacturing is, at the ground level, is slowly moving back to some of these countries, at least from a risk perspective, right? COVID at least showed most of the countries that some of the manufacturing should be localized. So that's one thing which I think that's a very valid trend which I'm seeing. The other kind of a little bit of a non-consensus thinking which I have is that the oil and gas sector could surprise us in the next 1 or 2 years. And again, it's not a projection, or it's not a like a prediction. It's the same capital cycle which we are talking of, right? That the amount of capital spent in this sector has been very little. So the whole demand supply situation is fairly evenly balanced. So if economies, think of it this way, right? We're talking of recession, interest rates increasing, slowdown, and oil has still been stable at 78, 79, whatever, $80 a barrel. What happens, and obviously China is coming back on, what happens if demand starts recovering across, right? If things really start improving, there is always a risk of an oil shock. Again, oil shock may not be a very long oil shock, but there can be spikes. So that's, I think, that is something which is currently not being looked at, but that's, I think, a risk to keep in mind. How do you manage it? I think companies which, that's a risk on inflation, right? So obviously I think in terms of short, for that, look through the 70s era, right? Inflation, when you keep reading and hear about inflation, and I think none of us were definitely investing around that time, but when you read the history, inflation is not like it stays at 10% for 10 years. It's not like that. It's like a wave. It goes to 12, then it goes to 5, then it goes to 7, then it goes to 5, then it goes to 10 again. So keep that in mind. If we, for all this could be a lull, and then it could go up, and then it could go down. So it keeps going up, down, up, down. So that's another risk I think we should keep in mind, that we have entered into a slightly higher inflation era, and you could see this boom and bust kind of an inflationary cycle, for the next couple of years. So in a broad sense, we have to become a little more cautious about what valuations we pay, right? Because investors will slowly start, readjusting their terminal valuations and all that. So I think, that's another point to keep in mind. And I think I put certain tweets and a chart a year and a half back around, how you can think of valuations, and how interest rates do act as gravity on valuation. So I think that's an important point to keep in mind.
So
So
that's about.
that's about.
Definitely more than 3 hours and investing talks are like you end up talking and talking and talking. Great, great. So sir, it was
Correct.
really insightful and kind of you to agree coming to my spaces for the second time. And surely if we have something more interesting to discuss, we will surely come request you and you will come again.
Yep.
So thank you guys for sparing time on Saturday evening and that too for 3 hours
Yep.
in a row. So it was great session indeed, and it is recorded. Those who joined late or maybe missed it from the beginning, they can last time we missed on to recording some 1 hour session. I mean it was part recorded, so that regret is not happening this time, but yeah, initial glitch had something. Anyway, that is part and parcel of this Twitter spaces. So thank you Rohit sir once again, and guys, like if you're liking our work, please feel free to connect so that you can get in touch with more learned people and know the nuances which are very helpful in your journey. So any closing remark, Rohit sir, before we close?
No, nothing from my side, but thanks all. I appreciate you hosting this, Prince. I follow the other speakers you bring on board, so definitely a great effort to to share and learn from this. I think it's definitely a fantastic effort to follow all the people you bring on board, and appreciate everybody joining in. And I'm amazed that there is so much patience and interest for taking time out on a Saturday evening. And I know there are more fun things to do in life. So appreciate
Appreciate
everybody
everybody
joining.
joining. Right, sir. And the community is helping two ways, sir. Like one, they are getting, they are learning things with the speakers, and contrary to which the circle is expanding in the sense like people come up with their set of recommendation that this person is a value addition, and you try reaching him or her out. So this way also, like I, the circle of our guest is growing, and the only idea is to educate and grow in our journeys. So all the best to everyone around, and Rohit sir, please keep adding value like you are doing since 2 decades almost. So thank you so much. And moreover, like would request, like although we also discussed the same last time also, so do consider writing a book. That would be great help to the community.
Definitely.
Thank you sir, good night, take care.
Sure. Thank you, everyone.
Bye guys.